Is Montepaschi in Florence? I don't know enough.
I'm sure you'll seek one out. I'm sure you'll seek one out. Just getting some lines crossing around Renault, which links to a Nissan share sale, which I think is interesting. Renault seeing a capital loss of up to 450 million euros from this Nissan share sale. The capital loss would impact Renault Group's net income, so we'll certainly keep an eye on that one. That news around Nissan crossed just minutes ago, and there's the Renault line to sort of complement it. So we're open across European equity markets. 8 o'clock here in London. European equity market futures have been pointing a little bit lower, so we were expecting to see some downside, not by much, but a little, and maybe that's coming through. US futures point a little higher.
Shell's down, BP's down, Total's down, so the big energy companies are coming down. We saw quite a build in inventories yesterday being reported out of the States, so that's the reason why oil came under pressure. Christian Melek over at JP Morgan's talking about maybe us going back up towards 100 on the Russia story, but the near-term story is very much for oil weakness. You're also seeing some of the commodity stories more broadly being pushed down as well, so iron ore is a name. But that's been complemented this morning by the big gainers coming through in the pharmaceutical sector. So oil is down, pharma is up, Novo's up, Astra's up, Novartis is up, Roche is trading higher as well. So that is where the action in terms of the point story this morning is upside and downside.
My eye went straight to the shippers simply because we had a 5% decline in AP Moller Maersk off of the bridge story from yesterday that's having a read through today. Today, a bounce back in the shares, at least in terms of the opening trades, higher by 1.4%. I'm curious what the logic is there. Is it simply a bounce back from the hit it took in the stock yesterday, or is this a higher shipping costs read through story?
I think it's probably a bit of kind of the former, in as much as it got dinged yesterday quite badly when that headline came out, but it looks as if they didn't have anybody on board, so maybe their liability potentially could be limited as a result of that. There's a fascinating, if you want a really interesting read this morning, and you want to read about the impact around insurance and the Titanic, there's a great read out there. Apparently, liability could be limited to the value of the ship and the cargo that it's carrying.
Okay.
I'm going to add that to the weekend reading
list. We'll dig that out for later. Spanish preliminary, we've got some inflation data coming out of Spain, and I mentioned this because it seems to be moving in a direction that the ECB might be okay with, at least versus estimates. The CPI rising 3.2% year on year. The estimate was an increase of 3.3%, so lower than had been estimated. I think we're seeing the same in the core number, and of course the source of inflation issues for the ECB was never in Spain, but it's interesting to see that Spanish number moving in the direction that we want.
The month-on-month number is a little tick higher, which I think is interesting as well. And as you say, though, the core number is a little lighter too. Be interested to go into the component parts of this and just kind of see what the numbers look like. There's been a big energy story around what's been going on in Spain recently. We'll do that bit in just a moment. But yeah, initially the headline number below estimates, I think, is probably the read across.
We're looking out for, well, we talked about where H&M, we had some quite punchy suggestions for where the H&M share price would open, and actually it's only up by 1.6%, so it did outperform in terms of the profit numbers that you went through at the top of the programme, Guy, but there were these lines around inventory and in the second quarter and what that might do. I wonder if that weighs slightly, but we do have, of course, a new CEO at the helm of this business, Daniel Erver, taking over from Helena Helmerson, so we'll watch how that management story develops.
In terms of the Spanish numbers, clothing and footwear actually a fairly big contributing downside factor. Not as much as last month, but that has eased a little bit. So that's that's becoming less of a factor in some of this data that we're watching here. Communications looks like it's reasonably soft as well, but housing, water, and electricity still, that's where the deflation looks like it's that's where the the underestimate looks like it's come from in terms of the data.
A lot going on in the European markets. I want to very quickly mention the U.S. pre-market as well, because all eyes on that Trump SPAC here. DJT is your ticker. Trump Media and Telecom higher by, well, about 8.8% in the pre-market there. That follows a 16% gain in yesterday's session.
I should just correct myself. I think I was looking at maybe a price from yesterday, but the H&M share price up by 12%. So that is a substantial move on yesterday's share price. Let's broaden our conversation, think about where we go on global stocks. We had an interesting conversation with Laura Cooper from BlackRock an hour ago, where we were talking about, the outperformance of US tech, whether that continues, the underperformance of small caps in the United States. Let's remind ourselves of what she had to say.
It's certainly been surprising just how discounted small caps are relative to their large cap peers. And we actually closed our underweight on size about a month ago, just based on valuations, because we think there could be a technical bounce back. But ultimately, if we look at our asset allocation, we're still thinking that this tech leadership can persist, largely driven by the structural demand drivers of artificial intelligence. Yes, we've seen some greater dispersion in that so-called Magnificent Seven. It's now the Fabulous Four, let's say. But I think ultimately, yes, valuations are a bit extreme, but this is being backed by earnings.
Laura Cooper there from BlackRock. Let's speak to Virginie Massenet, a global CIO for equities at Allianz Global Investors. Joins us on set this morning. Very nice to have you with us, Virginie. Nice to see you. So we were talking there about underperformance of small caps, outperformance of tech. I mean, that sounds simple, but it is one of the big questions that the market is asking itself, whether that trend remains intact, whether anything shifts that or changes that. What are you looking at?
I think it depends on your time horizon. So tech has done really well. We like small cap as well. I think it depends on client needs and, again, time horizon. With regards to tech, I think you have to make the difference between the Max 7, as we've talked about many times, and the rest of the sector. Are we due in for a small air pocket? Maybe. But in that air pocket or that volatility, you want to add to your portfolio if you do not have names in cyber and in the wave of deployment of AI, which is the key thing. We are currently building the plumbing in AI. Same as when we had the mobile Apple phone at the beginning. It was a nice device with a map and a camera. And then it took a few years for it to become really operational and have an impact. And we're in that phase. Of course, for AI, it will be accelerated. But there's a lot to come. So it's been one of my themes for so many years. I think that you look at the stocks, you look at the balance sheet, you look at the vision of management, and you pick the stocks if you have a bit of volatility.
Okay, and you say there's still room to do that within that sector. Yeah. We also talked to Laura Cooper earlier about whether we are in a long-term higher inflation world than we've been in for the last 10 years or so, or at least post-GFC, pre-COVID, so comparing it back to that period. Do you think we are? And if we are, how is that reflected in asset allocation from an equities perspective?
Yeah, so I think clearly there's a lot of major trends and shift around the world, one of which is the shifting new world order with China coming up, more disruption, more fragmentation. And of course, if we had, depending on the president we end up having in the US, definitely more disruption and fragmentation. So that's one thing. In that, you also have the long-term trend of climate. Right? You have the long-term trend of demographics. Those are inflationary. Those are in underpinnings of the inflation. And of course, productivity increase AI is deflationary. But I think we'll land on higher inflation than what we've had in the last decade. It doesn't mean it's bad, as long as cost of capital is appropriate. It also means that markets need to readjust. There's still that target of the 2%, and it's possible that it ends up being higher, particularly if those tariffs end up being imposed, which, it will be a one-off. But if you look at the 10% on 18% goods in the inflation basket, that's already a 1.8, and then 60% on China, about 0.5. So you would have a hit on inflation at the time where projections for budget deficits in the U.S. are clearly 7 and plus. So, you have to have a compensation for that risk in the market.
That seems like a very bearish take on equities. Why are the markets not pricing that in?
I think there's two things. It's not bearish if you adjust to it and if you have the right companies with the right balance sheets, not stretched. We've done a lot of work on the wall of refinancing. So, the zombie companies, if you want, that have been surviving on very low cost of capital, for those, that's going to be really hard, right? Yeah. For companies who have growth plans, vision, strong balance sheet, strong leadership team, agility, more than ever is super important. The world is in this trend of digital. Darwin is emerging towards tech. Yeah. Those will continue to do well. But it's a stock pickers market. It's definitely not an ETF market.
But you mentioned the maturity wall, and I think that's really interesting there, because we're starting to hear this kind of enter the conversation more and more. That maturity wall, the debt financing here, has been largely driven by these massive profits that you've seen on corporate balance sheets on both sides of the Atlantic. It's fueling buybacks here in Europe, which is my personal obsession. What happens when those profits go away? Because so much of that is stimulus funded, it's government funded. Mm-hmm. We don't have that same kind of liquidity anymore. How much of a risk is that debt wall?
So I think you definitely need to be very careful. It's stock by stock. I think the up to 2025, with the work that we've done, says, we are okay. By 2025, depending on all the other elements we're talking about, we still think rates will be lower, although you have to watch the long end, right? Yeah. So I think it's that cleansing mechanism, if you want, in the market, where the strong companies will get stronger and some of the weak ones will go away. On buyback, what's interesting is, forecasts are still showing an expected 13% increase of buyback in the U.S. for 2024, and another 16% to over $1 trillion in 2025. Most of that concentrated in tech. So, there's a lot of money going towards buyback.
You're saying it's worth paying for active?
Yes.
That has not been the recent experience.
Yes.
How convinced are you that I should pay for active?
So it depends on how you measure it. Okay. So if you look at a trend of declining or negative rates, in that trend, the wave takes it all. But then if you look at specific opportunities or themes, look at cyber and AI versus the rest of the market, you just have to be looking at very specific opportunities and where you see that not only that earnings power on a 12 or 18-month basis, but also 3 to 5 years. If you look at China, look at the index in China and look at some of the stock performance that we've had. So it's all about differentiating. It's a lot of bottom-up work. But I would say that in a rising or in a higher interest rate environment, we've definitely seen the difference.
I can just buy the S&P. I can just buy the NASDAQ. But I'm picking up some of those benefits. I'm also picking up the turn. Are we convinced that these are going to be the leaders? It's been a momentum story. Does that momentum story carry on? These are momentum stocks that have huge amounts of following with them. But if you get a turn, the ETF is going to protect me from that turn because momentum is going to pick up somewhere else.
Well, except if from a bottom-up perspective, you pick up the next trend and you have very careful portfolio construction. So I think what you do is you really have to follow what I call the portfolio construction pyramid. At the bottom of your pyramid, i.e. where you have the most assets, you have your multi-factor, low-vol, anchoring portfolio kind of base. The next level, because we're in a volatile, changing world, new world order, disruption, fragmentation, quality in different styles. We're not going back to zero rate. Quality growth, quality value, quality income. Income has a role. At the top of the pyramid, you have your more volatile themes: cyber, AI, demographics, energy transition.
So this isn't the whole portfolio. This is
a whole portfolio.
But the top of the pyramid is a small part.
Yeah, it's a small part, but it will be the one that can give you, a lot of performance over time. Or the alpha comes from every bit.
Right.
But you want to dampen your volatility by anchoring your portfolio at the bottom of the pyramid with, as I said, multi-factor, quant, AI signals. I mean, we have some really interesting strategies in that area. But the key thing is that dampening of volatility. And then I think that solution works. And of course, if one part does better than the other, you rebalance the portfolio over time.
When does the cyclical piece of the equation pick up? If you're worried about zombification, you're worried about not as kind of quality companies not being able to survive the dynamic, when does that cyclical turn actually happen? When are you pricing that in?
So I'm not worried about zombie companies because we don't own them. What I'm saying is it will happen. So what you need to understand is, will the zombie world touch your companies if you bet in the quality space?
But
right?
when will it happen?
When will it happen? I think it's more of a story depending on the growth underpinning. It's a second half 25 story. Although in specific areas, you will see, so if you look at the property sector, that's really interesting. You look at commercial real estate and you're thinking, well,
I'd rather not, but okay.
Yeah, exactly. However, the risk is very distributed in the financial system. So yes, you have headlines around, building sales at 50% of the cost of the debt or of the debt, right? Yeah. But actually, what matters in the end is where is the risk? Who carries the risk? And is it creating systemic risk or is it ongoing? So on your question on growth, which is really what the next story is, right? So the question has been focused, the debate has been focused on rates.
Yeah.
Now you sort of have a 75 bips path, you sort of have consensus, and we were always in the camp of, higher for longer and less cuts, right?
Yeah.
You have sort of a mid-year consensus. But of course, depending on how growth unravels, so can Europe green shoots really pick up?
Right.
And is the path for the US really for an organized slowdown, or actually will we see more resilience? You will have or not that central scenario. And of course, what markets are going to react to is departure from that central scenario, right?
Yeah.
I think the US economic resilience will be there. I think it's really important to pay attention to what's going on. So you talked about oil prices earlier on. We talk about the global supply chain. Those are really important points because they will test the resilience of inflation in a world where when we know or when we have a sense of who the next president in the US is, we'll have a sense about that shock inflation on a one-year basis through tariff.
It's going to be an interesting year ahead.
Yes.
Virginie, as ever, thank you very much indeed for stopping by to see us. Really appreciate it. Virginie Maisonneuve, Global CIO for Equities, joining us from Allianz Global Investors. Thanks very much indeed. Quick look at the core six here in Europe. Look at what is going on. These are the stocks that often define really what the core portfolios are going to be doing. You can see the pharma mix. Nova's up a little bit today. You've also got ASML moving up. The chips are having a better day. But you do have LVMH with a little bit of softness as well today. You're seeing Schneider down as well. Schneider's the kind of the AI picks and shovels grid story that is so interesting to watch right now. Let's talk about some of the other individual stocks that we're going to be talking about as well. Joe, talk to me about fast fashion.
So H&M, Guy, by far the best performing stock on the Stock 600 today. It's up around 12% at the moment in Stockholm following the quarterly earnings report. Now, this is pretty much retracing a massive drop that we saw in January following weak sales. Sales have started to rebound in February and March as well, according to analysts, and they're also pointing to this 10% operating margin target, which is better than some analysts had expected. In terms of a read across, the Primark owner, AB Foods, is gaining around 1.5%, probably the biggest relationship in terms of the two similar price offerings of them. Zara owner, Inditex, up almost 1%. Not too much movement in Next, but H&M really rallying today. Then we'll have a look at these paper and packaging stocks where all the M&A excitement is, because we had news of the rival bid for DS Smith, this coming from International Paper. Now, it had an implied value of 415 pence. We can see the stock trading at below 390, but potentially that's because the IP share price declined in US, as we said on Stocks to Watch. That reduces the value of the bid. Here's Mondi, the company that had made the two previous bids for DS Smith. That one actually coming up. There was concern that they might actually have to come back with a higher bid, and that could be seen as a negative. But at the moment, not seeing that. It's gaining, as are a couple of other paper stocks, including Smurf there. Anna mentioned earlier they've done their own M&A with WestRock recently. UPM over in Finland up almost 1% as well. An interesting sector at the moment. Then we'll take a look at a couple of decliners. Banca Monte dei Paschi was slipping. That one down 2.5%. The Italian state offloading that massive chunk of shares, around 12.5% of the stock. One that's pretty much off the radar in terms of our stock coverage, but it is the worst performer on the Stock 600. It's called Fort Knox. It is a company based out in Denmark and also Stockholm. They have businesses there as well. An FT report talking about short seller interest. Breaking news on that. We're going to reach out to them and try and get a response, but it's the worst performer today. Software company down 9%. Then in terms of a couple of broker moves, we have got some on the banking space. Morgan Stanley switching its preferences. They are upgrading Deutsche Bank today and downgrading Crédit Agricole. So here's Crédit Agricole. They've got a sell or an underweight on that one. It comes down to 0.5% on the French market. They say that this is a relative underweight. It is underperforming given some of their French retail exposure. But as I mentioned, Deutsche Bank is the one they prefer. And that one, there we go, that up 3.4%. They like the rebound in Deutsche Bank's trading business. Finally, a downgrade for BMW. This is a valuation call from Jefferies. Quite a bearish analyst over there. Philip Houchois has a lot of bearish ratings, but he is also downgrading BMW today, and that one's falling 1.4%. It's after a bit of a decent run. That one is declining in Germany.
Joe, thanks very much. Joe Easton from our equities team with a rundown of the things on the move. One stock certainly on the move is H&M. We're going to get to that conversation shortly. As we've been hearing from Joe, H&M reporting earnings this morning. We'll get more on the company's plans under that new CEO. This is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it is continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do three things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
When I was younger, I used to be in bands. I'd play drums in bands and toured America with them. Did a lot of session drumming, recorded albums. So yeah, it was good fun doing the drumming. The only reason I stopped it, well, I still play, but not as serious as I did when I was younger. But drumming doesn't pay the bills. I was never good enough to be able to pay the bills with it, but it was good fun. I started RJF, and the reason I started it was I saw a gap in the market for particular early stage and startup businesses. With the experience that I've got of running businesses, of being a finance director at the very biggest companies in the world to being finance director of small startups, we were looking at providing more than just basic accountancy services. So yes, we'll do all that, we'll do all the basic, all the statutory side of things that you need to do. But there's so much more value that we can add, and I wanted to have my experience to help these startups, because a lot of them don't really know where to go. You can go to your high street accountants and they can do a good job compliance-wise, but you would question whether they've actually been in the fire line of a business. Have you been in a business where you're thinking, how do I pay wages next week? Or business is really successful, what do we do with it next? Or how do we grow it? How do we grow into international territories? Or how do we grow our markets? How do we expand? So a lot of the experience I've seen over the years and seen different types of business in different sectors, I thought, well, it's a real value that I can add to these businesses as opposed to just being an FD, because a lot of these businesses can't afford an FD. But if we can take care of their statutory side of things, the compliance side of things, I'm on hand to be able to help and advise businesses with their growth strategy, or if they're in difficulty, help them through these times.
Jonas, thank you very much indeed. Jonas Ekblom on what is happening with H&M. The stock up really nicely this morning. The market really responding to a much more positive outlook from the new CEO. It's really interesting that you would have thought that this idea that people are spending so much money on services going out, Taylor Swift concerts, you'd be wanting to buy the outfit that goes with that. Those two things don't necessarily feel like they're going together at the moment.
You've been dying to mention Taylor Swift. I think it's interesting is the pricing. The CEO has already mentioned there that they're talking about making sure its pricing, especially in the U.S., that story of consumer resilience is still competitive. And I thought that was quite interesting. Coming up on the program, we're going to go back to the macro here. The yen in the doldrums. We're going to talk about the Japanese currency. It's hitting a 34-year low against the dollar. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal. That deal. The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Wow.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Markets Today. We're about 30 minutes into the European trading day. We are awaiting headlines coming out of Sweden, which are just hitting the Bloomberg terminal. As expected, the Sweden's central bank leaving the policy rate decision at about 4%. The estimate there was a consensus of about 4% at a hold as well. Going into the decision, though, you did see some weakness into the Swedish krona. It looks like that decision largely expected.
Yeah, but the next bit that's interesting is that there could be a cut in May or June. They're basically opening the doors to the May cut, which a lot of people have been speculating about. The idea would be that there's no reason not to cut at that point, but there is also this idea that they're probably waiting for some extra certainty to come through from the ECB as to when it's going to go before they make their decision.
Yes, because if they decide to go through, it was interesting, Ben Ram on the Markets Live blog writing about this earlier, saying this is not going to be the SMB, it's not going to be a big surprise. Yeah. They, of course, famously have gone before the ECB, but even if they went in May, that would be all things as we would expect them. That would be before the ECB. It does seem as if the wage data in Sweden gives them less reason to hang around before cutting. Yeah. That was one of the things.
They're running out of reasons not to, I think, is probably the argument that seems to happen here. And what you're seeing certainly is the Swedish krona coming under significant pressure as a result of this. Now, remember, we've gone from a kind of 10 to, where are we now, 11.5 over a reasonably short period of time here, and that move looks like it's going to be continuing. So it's this line about May, so it looks like we could see a little bit of pull forward in terms of when that rate cut ultimately gets delivered.
And we know that it has had a lot of kind of growth concerns as well. Inflation is no longer the focus in Sweden as well. I think the front-running the ECB story is interesting, though, because I think the consensus has been now that the Swiss National Bank has come out in front, the BOE expected to front-run the ECB. Does the ECB even matter as kind of being the first? Does that order?
Does it matter? We keep asking that question about do you go for the ECB or not?
I think the S&B's gone significantly in advance of the ECB. I don't think there'd be much. I think the Riksbank would want to be reasonably well correlated with what the ECB is doing. It's not going to want a 2, 3, 4 month gap. I think a 1 month gap it could probably tolerate. And maybe it's at the point where, we know the ECB is going to go. We're comfortable now. The data supports it. We were worried that the ECB would delay. Now we're certain that they're going to go in June.
Okay, let's bring in another voice on some of these FX moves. And from the Swedish story to the Japanese story, there's a bit to talk about this morning. Markets Live Executive Editor Mark Cudmore joins us once again. And Mark, we were going to be all about the Japanese yen, and we have had an as-expected decision from the Riksbank. So in that sense, there's not so much to talk about here. But it is this line about rates may well be cut in May or June, which then opens the door to the idea that they could go before the ECB. I wonder how much you're thinking about that, the ordering of these central banks right now.
I'm delighted by this pivot, Anna, because, in fact, this gives me a perfect chance to highlight that just today, actually, there was an update of my FX scorecard model, which has been running for most of the last decade on Bloomberg. And this week was the first time in that 10 years that Swedish krona has dropped to the last ranked currency on the model. The place it took was the yen. So the yen has been the bottom ranked currency for most of the last 3 years. There's been periods where it hasn't been, but for much of the last few years, the yen's been the bottom placed one. Now it's second from bottom as the Swedish krona has taken the last place. Now the model actually turned short the Swedish krona on the 28th of February. So it's been short the last 4 weeks, and this is just an extension of that trend. So I think it's very kind of interesting. This is a country which is a really, really struggling economy. It's got worse growth than Europe. We talk a lot about Europe's growth problems, but Swedish economy is struggling even more. It's got a high unemployment rate, and that's despite the fact it's got negative real yields. And, you know, I know we all talk recently about the soft inflation print means that the Riksbank's going to be cutting soon, and as we're talking about there, will it get ahead of the ECB, etc. This is a central bank which is cutting, but it's already got negative real yields which aren't helping an economy that's struggling. So I think there is a perfect chance to try in the Swedish krona and the Japanese yen. In my model, Swedish krona has just this week fallen below the yen.
All right, I got to zero in on this yen story because one of the questions we've been asking this morning in particular has been whether or not the FX volatility that we're seeing that's been kind of boring and very, very low, do we see some sort of spike, and how much of that is a result of kind of the carry trade as a function of the Japanese yen just kind of being the no-brainer trade right now? At what point do we see that dissipate?
I think the catalyst for volatility to return to rates market is when we get, to FX market, is when we get rates divergence again. So the big theme of this year is that rates markets have been moving largely in tandem, despite the fact we've had a massive dispersion or a divergence in the growth stories. So we've had Europe, the continent of Europe, so whether it's mainland Europe, Eurozone, UK, Sweden, as we just mentioned, having lower and lower growth estimates, while US growth estimates upgraded. Generally, the rates markets have been moving largely in tandem. And so I think that we get FX volatility when we start getting that dispersion in how rates markets respond again. When will that happen? You know, I didn't expect them to stay as correlated for so long. And in fact, we're starting to see a little bit more of a break in recent weeks. But I would expect the next couple of months we will see that rates divergence, and that will bring volatility back to the FX market. I think if we do get yen intervention, we get a yen spike, that's just a short-term event. That's not going to bring volatility back to the market. And I don't think it's all about the yen carry trade, which is just kind of keeping this volatility low.
Mark, I want to come back to a kind of theme we talked about yesterday, which is that the Fed seems to be hinting that it's going to be quite tolerant of inflation, potentially around 3%. Now, that takes you to a potentially, a 5% 10-year. What are the implications of a 5% 10-year and a market that is more cautious when it comes to US debt? How does that ripple across? Does that keep the dollar strong, or is that dollar negative? I'm trying to work through the kind of connections into other territories that we may see off this.
So, I think this is a great question. So I think, first of all, everyone's very focused on a level of yields, and I think it's very hard to identify a level. I think it's when those yields are high enough for long enough to start materially affecting the US economy. And I think that we're still a long way off from that. At the moment, the economy is holding up very well. And given that the Fed, since December, has given it a fresh dovish tailwind, we've got another boost to the economy. And so, you know, it's been very clearly a no landing. We talked a lot last year. I was in the hard landing camp towards the end of last year. But I always said there was going to be no soft landing. And there's definitely no soft landing. There's no landing at all. We've got a no landing. We're taking off again. And so, therefore, I think yields can go a lot higher. At what point does that become a negative story for equities? Well, when the economy suffers. Now, you asked also about the dollar. I think that when we get to that next tailwind, because it might, when that next kind of, headwind for the, you know, in terms of yields going so high that they're squeezing the economy, they're squeezing equity markets, I think the dollar won't be a haven in that environment. I think we'll probably have rallied so far, so long, played the US exceptionalism theme for so long that I actually think the next time that yields start to squeeze the economy badly, it won't be the dollar that's a haven. You'll actually see some of those US exceptionalism trades coming out of that market, coming out of both the equity market and the bond market, and find opportunities elsewhere in the world.
Mark Cudmore there, our Bloomberg Markets Live executive editor, walking us through a little bit of everything around the world. We thank you so much for joining the program. As he was speaking, we got some headlines here. A trip that we kind of knew about, but the Dutch Prime Minister, or former Prime Minister, I should say, Mark Ruta, is that how you say it? In Beijing, meeting with Xi Jinping. This was on the docket. We knew that this was happening. We also know that economic ties were going to be on the agenda among some of the talk around the wars in both Gaza and in Ukraine as well. But to me, what's so striking is the ASML conversation, simply because they are kind of stuck between the two global superpowers, the United States pressuring the Netherlands and the ASML to deal with kind of that sanction story. How much does this conversation change that?
Yeah, I mean, this is a business that's faced increasing levels of restriction rather, in terms of what it can do in China. And China and Taiwan, big markets for this business, for the Netherlands' largest company. So in a meeting of these two people, you would expect this to be a topic of conversation.
The Dutch have already picked sides there, haven't they? And that's what it feels like up until this point. The Dutch have been quite hard on ASML in terms of the restrictions of what kit it can ultimately export to China. The US has been putting significant pressure on that. So it feels like the Dutch have already picked sides. I wonder whether or not this meeting kind of softens the edges a little bit, whether it's possible to soften the edges. Because this is increasing in the narrative. Companies are having to pick sides, particularly in key strategic areas. You're either with us or you're not. And the pressure if you're not is substantial.
Yeah, although we had different views, didn't we, from some of those other global businesses that are attending that Bow Wow forum, saying that they see opportunities to still do business in China, and it isn't about picking sides.
But I think the characters here are actually quite important as well, because Mark Rutte also expected to be the leading candidate for NATO at a time when China and Russia are expected to kind of form this axis of power with Iran as well. So how much of the security concerns that really began in the chip sector and the cyber sector expand to actual wartime?
It's going to be an interesting conversation. Maybe that's ultimately what his objective here is, rather than kind of focusing on Dutch matters. He's focusing on geopolitical security matters.
Yeah, maybe building up some of those relationships, although he's probably got these relationships having been at the forefront of European politics for just as long as he has. So that's the story around geopolitics. I mean, if we do start to see the fracturing of the global economy into different regions, this is all inflationary. It raises questions about global trade, which does take us on to our next story, because, of course, yesterday, this time, we were very preoccupied and remain focused on the collapse of that Baltimore Bridge. We'll come back with some analysis on the impact of that Baltimore Bridge collapse. We'll speak with Emily Stoutsball, who is a market analyst at Zenita. That conversation next. This is Bloomberg.
portfolio of businesses, it is about resilience, it's about pressure, it's about women. Like, so how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group, where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. and all those skill sets that they've built. To me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
It's going to take some time. The people of Baltimore can count on us, though, to stick with them at every step of the way.
Our work is just beginning to rebuild this bridge and deal with impacts in the meantime.
The preliminary investigation points to an accident. We haven't seen any credible evidence of a terrorist attack.
What I can tell you is a search and rescue is still underway. So we are very hopeful.
The FBI has been part of this response from the beginning. We came within 1 hour to the command post.
We're not leaving until this job gets done.
President Biden and Transport Secretary Pete Buttigieg talking about the impact of the Baltimore Bridge collapse yesterday. The disaster, of course, we now understand happened kind of around this time yesterday as a cargo ship lost power, hit the Francis Scott Key Bridge, as well as the auto industry. The incident threatens to disrupt as much as 2.5 million tons of trade in coal that comes out of the port of Baltimore. Emily Strauss-Ball, market analyst at Zanetta, joins us now to give us an assessment of what the impact this is likely to have. Emily, we've been dealing with supply chain crises for quite some time now. How does this impact and add to that crisis that we've already been having to factor in?
Yeah, every little bit is going to add to the pressure that we're already under. But I think if we're comparing it to what we've seen in recent months, even with the Red Sea and with the Panama Canal, this is a much more regional situation on the ocean side of things for the container shipping market. It's manageable with the volumes that are currently going through the Port of Baltimore. It gets then very tricky for those who have to take the cargo onwards from the port to your warehouse, to your shops, or into the port, right? You will have had a setup that makes sure those containers get where they need to be. And if they're suddenly being unloaded or having to go to another port to be put onto a ship, that causes confusion and a problem that needs solving.
So the biggest effect is likely to be therefore in trucking rates rather than seaborne freight rates. Is that what you're saying?
Yeah, so for container shipping, most of the ships that call at the Port of Baltimore, their schedules will already have a port call either in the port further north of New York, New Jersey, or further south down at the Port of Virginia. So those containers can be taken on and off those ships at a slightly different stage than they would have earlier, but then getting the container further to where it goes, that's where you need to find a new solution.
Emily, I know your good morning. I know your expertise clearly around the trade side of this, but watching as closely as you do the shipping sector, I wonder if you have any thoughts on how rare this is, how this happened, how this came to pass. We understand that there was a loss of power. That does sound like a pretty rare event and a sort of freak accident then unfolding. Is it as rare as it seems? I mean, how vulnerable is infrastructure to this kind of thing happening?
Yeah, so I'm no expert on the sort of technical navigation of ships, but we saw just a few weeks ago a ship collided, I believe it was in Turkey, into the port it was at, causing some damage to the cranes they had running. And I mean, we think just a few years back to the Ever Given getting stuck in the Suez Canal. So we're getting used to in container shipping, certainly, that actually the proof that the supply chain is vulnerable and there are points where it can go wrong. Clearly, this is a step up from that situation with a whole port being called out, and of course the tragic events and people dying. But container shipping is resilient, and supply chains are going to find a way to keep working and to keep those goods moving.
Yeah, we see, Emily, that this port handles a lot of very varied items, you know, from cars to industrial machinery, lumber, coal, gypsum, all kinds of things being mentioned here. Cars, I know, take specific infrastructure to handle them, so you can't just send them to any other port. They need to be going to a particular port. I imagine a lot of those other products require specialist handling as well. So how flexible can you be in thinking about which other ports you use in place of Baltimore?
So I cover purely container shipping and a little bit of air freight at Zanetta. But if you look at the port infrastructure along the US East Coast, there are alternatives. Obviously, there's going to be a question of capacity and how much can they manage. But I think it is going to be manageable at the current levels of trade we're seeing. There is capacity in those other ports to take it. It just needs a period of adjustment.
Emily, at the very beginning of the segment, you were talking to Guy about kind of the other pressure points around the world, the Red Sea story, the Panama Canal story as well, now Baltimore. I can appreciate that this is becoming a bigger issue in terms of eating into that shipping capacity. I'm curious about that excess shipping capacity, though. How much room is there for companies to maneuver? How many more accidents might it take for us to see a crunch once again?
So absolutely, and as soon as you have a situation like this, the slack that is available at other ports gets much smaller, and suddenly it's much tighter. I would say on this side with the incident in Baltimore, we don't expect it to have a huge impact on the capacity needed on the shipping side, obviously in terms of what the ports can handle, but also what the ships can handle, where you see the situation in the Red Sea. When you suddenly have all the ships that have to go down south around Africa, that takes much longer and requires many more ships to carry the same amount of volumes. At the moment, we're not in particularly high demand. We haven't seen that strong growth, and certainly we're lower than the levels we were in 2021 and 2022, when US ports were under particular pressure with high imports coming largely from the increase in consumer spending on goods during the pandemic. So we have some slack room. We have a lot of new ships that were delivered last year and that are being delivered in Q1 this year and throughout the rest of this year, really. So the market is able to meet the demands. And again, just that actually supply chains do prove very resilient, even when put out from, if you're trading from the Far East to the US East Coast, you're now struck both by limited transits through the Panama Canal with low water levels, then the Red Sea being closed off for most major carriers, and now also one of the large ports being cut off.
But Emily, talk to us about that rerouting story you just mentioned, the kind of rerouting in terms of more ships, sure, on the market, but also going around the Cape of Good Hope as well. In terms of time horizons, we can appreciate that labor costs, fuel costs, et cetera, can be passed on to the consumer. But in terms of kind of lead times, has that situation eased? Is the transport faster, or are we still looking at almost double the journey time?
So the double journey time is stable now, right? The big problem was at the start of this crisis, when everybody who's put containers on those ships thinks they're arriving at a certain time, and suddenly you have that extra transit time being put in place. And there we saw a lot of pressure on getting space on board ships to get out. We also saw people moving to air freight or to rail to try and mitigate that, right? But now we have a relatively stable situation. The longer transit times have now sort of been built into the system. So the key is not necessarily how long it's going to take, but actually that you have planned your supply chain enough that you can build in the fact that there's now 2 weeks longer transit time. So as long as that stays the case, your supply chain is okay, because you know what you're dealing with and you know to plan ahead.
You can plan ahead. Is the sense now within the shipping community that we have a long-term problem with the Panama Canal, we have a long-term problem with the Red Sea? It's probably going to be years before we see maybe Baltimore being kind of fully back in action, you could argue. It's going to take a long time for this bridge to be rebuilt. That's going to affect trucking for quite some period of time. Is there a sense that supply chains are going to be remaining snarled for an extended period, that there are no easy, quick fixes here?
For sure. There are no quick fixes, and this is completely out of the carrier's hand of the people in the supply chain, right? This is a setup. We know certain carriers have talked about returning to the Red Sea and the Suez Canal. We have yet to see many ships actually making that change. But but it is built in. And if you look at what carriers were presenting alongside their Q1 results and their expectations for the rest of the year, this is set to continue. But we are still returning to a normalized market conditions where you know what the new status quo is, you know the transit time, you know more or less what price you should be paying for those containers.
And you can plan for that accordingly. Emily, thank you very much indeed for jumping in and joining us. Emily Strauss-Bold joining us. She's a market analyst over at Zenetta, a shipping analytics company. We're going to be hearing from several automakers later today. The US heads of Volkswagen and Nissan will be joining the surveillance team a little bit later on to give us their take on what impact this is going to have and how long the effect is likely to be, Anna.
Yeah, I think this is going to remain one of the topics of conversation. It clearly dominated the narrative yesterday. I'll give you a quick rundown of some of the things we're looking out for in terms of the trading diary, but of course we will focus on some of those big car CEOs in our US conversations. The ECB's Cipollone will be talking. Kazakh's also speaking today. We'll get Euro area consumer confidence. That's interesting as we build a picture on inflation and the pace at which it comes down. We've had Spain. We'll get further inflation reads through this week. South Africa has a rate decision at 1 o'clock UK time. And then later on tonight, 10 o'clock UK, we will hear from Christopher Waller. Guy is going to be tuning in for that. Well, actually, probably not live because we might all be asleep.
I might be.
To be honest.
Yes.
But we will tune in after the event.
I'll look forward to hearing what he has to say a little bit later on.
We will catch up on the Bloomberg terminal a little bit later on.
It's really interesting to see at the moment kind of how these alternative speakers run the Fed, sort of Powell and Lagarde, etc., how you're starting to see some division maybe emerging, more so maybe at the Fed than you're seeing over at the ECB. And I think it's going to be fascinating to watch that. I think Bostic's really set the tone. I'm only expecting one cut.
Only one cut. Then other voices, 3 cuts. There's quite a lot of divergence there in those Fed views.
There's no roadmap here. There's no historical parallel that we can make, because I think when the kind of inflationary impulse first started, everyone had this almost PTSD from the 1970s that you can't actually you can't over tighten, because then you risk the Volcker kind of mistake of not going hard enough or even going too hard.
And then Volcker correcting it.
Right, exactly. Yeah. And the issue then you see is then it's kind of been, okay, well, if that's not the case, do you then look at Greenspan in the 90s? Is that some sort of way of monitoring this? And I think what we found is that we've never done this before. We've never seen it. And there isn't even any other central bank who's viewed it either. To me, overnight, it was the, sorry, go ahead. I didn't mean to.
No, it's all right. No, I had a thought.
Excellent. What is that thought?
Yeah, they hit me.
My thought was just a number of parallels have come out through the last couple of hours of programming with periods of history. So you're talking there about the 70s. We talked to Virginie Massenet about whether the CRE risks are, anything like the GFC, and she was saying, no, they're well distributed around the financial system.
But wasn't that the whole argument in going into 2008 that, we've distributed the risks, it's all going to be okay. The financial system is resilient in its totality to be able to handle it.
So we're back to
Turns
working
out it wasn't.
What those risks are and where they sit, where they are on balance sheets. But that was her view. But then, and we also heard from Laura Cooper how she doesn't think we're in for a sort of 2000 style bubble in tax, or arguably we're already looking bubbly. But she doesn't think that this has too many parallels with 2000 right now.
In the conversation of historical parallels, one thing we did talk about is that in the last 24 hours, Larry Fink over at BlackRock had also warned that the U.S. is headed for some sort of Japan situation where you have an aging demographic and a retirement crisis that the country is not prepared for. And immediately I was like, wait, this is the entire Japanese deflationary story. And I think that's obviously decades away, but it's one to be keeping in mind as we talk about historical parallels.
A story for another day, perhaps, but whether how does the financial model that we have globally, to some degree, cope with aging populations? This is
I'm not coping very well. That's just me personally.
With our own aging. No, that's a challenge.
Definitely a challenge. Okay, that wraps things up. Busy morning, surprisingly busy morning. Keep an eye on that yen story as maybe we see a little bit of liquidity returning stateside later on. Okay.
You go.
Rich Clarida is going to be joining the team a little bit later on. You want some insight? Rich is the perfect person to hear from. Really looking forward to that as well. Vlad Telev as well from Galaxy Digital. Novogratz is going to be joining the team as well. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Tom McKenzie in London with the conversations that matter. Here's what's coming up on today's programme. From cars to coal, the dramatic collapse of the Baltimore Bridge will cause weeks or even months of transport delays, adding another disruption to global trade. Japan steps closer to intervention as the yen slumps to its lowest level against the dollar since 1990. Plus, H&M jumps. The fashion retailer posts better than expected profit in the first quarter as its spring range draws shoppers. Let's check in on the stock story then of the moment on Wednesday. We'll look across the map here. Across the European benchmark, the Stoxx 600 is currently flat. At the top of the list when it comes to sectors, retail on the back of that beat coming through from H&M. Here in the UK, as you can see, the FTSE 100 is currently in negative territory. France is flat. A little bit more positivity coming through on the DAX over in Germany. The DAX up 0.1%. The FTSE 100 down 0.3. You can look to the commodities story for that. Softer iron ore and copper prices. Oil also lower in the session. And over in Italy, the FTSE MIB currently just eking into positive territory. That's a quick look then across the Eurozone and here in the UK. Let's flip the board and have a look at US futures after 3 straight days of losses across US stocks. Futures are looking slightly brighter this Wednesday. S&P evenly pointing up by 0.3%. NASDAQ futures pointing to gains of 64 points. And despite the 3 days of losses in the US, of course, we are still grinding towards 5 straight months of gains for US stocks. And there's the European benchmark currently flat at 510.90. Let's briefly look cross asset. The asset of the moment really arguably is the Japanese yen. You see at 151.50. They intervened at 151.95. The last time around, we've had some very strong rhetoric coming through from the finance minister, warning of intervention on the weakness that we've seen in the Japanese currency. Of course, the yield differential between the US and Japan remains significant despite that move into positive territory for interest rates by the BOJ last week. So the Japanese yen remains in focus on those intervention possibilities and the rhetoric coming through from officials in Tokyo. The US benchmark 10-year 4.23. They auctioned a 5-year note yesterday, around $67 billion worth of 5-year treasuries auctioned, and that was relatively well received by the markets. Brent, $85 a barrel, off by 1.2%, as you can see in the session. A report coming through suggesting that inventories are starting to expand in the US. JP Morgan, though, and their analysts see the potential for $100 a barrel on oil before the end of this year on the supply cuts coming out of Russia. Now, officials in the US city of Baltimore say active search and rescue operations have been suspended after yesterday's bridge collapse. 6 people are unaccounted for and now presumed dead. The disaster happened when a cargo ship lost power and hit the Francis Scott Key Bridge. The state governor says a mayday call from the ship allowed authorities to limit vehicle traffic on the bridge. Let's get more on this story with Bloomberg's trade czar, Brendan Murray. Brendan, what is the situation then in terms of the impacts, the economic impact for Baltimore, but more broadly, the supply chain wrinkle that adds to the U.S. economy?
Well, definitely. You heard the officials yesterday talk about how the port is such a big employer and it reaches far outside the city, so across the region. So what we're already seeing are ships anchoring off of ports like Savannah, like Charleston. It's not a large number yet. It's 3 or 4. New York, some ships are diverting there as well. It's not a large number yet, but if those 3 or 4 turn into 12 or 15 in the days and weeks ahead, then we could see some the impact of this broaden out. But for the time being, people are telling us that the impact the immediate impact will be local, and we'll have to keep a close eye on whether it spreads regionally.
Okay, so local in the immediacy, at least in terms of the largest impact, but you watch that spread, and you and the team are across all of this. What is your understanding of other ports in the US, their ability to absorb this trade flow being diverted away from Baltimore, and what kind of time frame are we looking at to get that port back up and running?
Well, the ports that we've been talking to say that they do have capacity. They'll say we're willing to work with Baltimore to take some of that spillover cargo. So that is, and at the moment, demand isn't going gangbusters in the U.S. economy. It's solid, but it's not. These ports are not at 100% capacity. Some of them are at 70 or 80%, so they can handle some of that. The difficulty will be on the auto side, where Baltimore is the biggest U.S. importer and exporter of cars and light trucks. So where can those vehicles go? If you've ordered a new car and it was supposed to come through Baltimore, it's going to have to come through Brunswick, Georgia now, or some other place, and be trucked or put on rail to get to its destination. So that's extra time, that's extra cost.
Yeah, Georgia, obviously a huge diversion then in that example. Okay, Brendan Murray, thank you very much indeed. Of course, European automakers as well impacted by this, given the need for Baltimore around VW, BMW, and other European automakers in terms of the trade into and out of the US. Brendan Murray, across all things with the supply chain impact of that, of course, bridge collapse in Baltimore. Thank you. Now to Japan, which has stepped up its scrutiny of the currency and currency intervention warnings with its strongest warning yet. That's as the yen slid to the weakest level in about 34 years against the dollar. Let's bring in Bloomberg's Paul Jackson then for the details, what we've been hearing from policymakers. Paul, what have we been hearing from officials in Tokyo? Is there uniformity in terms of what we've been hearing from the finance ministry, from the BOJ? How pronounced now is this risk of intervention?
Well, we're definitely a step closer. The key word used today was we are prepared to take bold action against excessive moves. Bold action is the coded language for direct currency intervention. And that's coming from the finance ministry. That's aiming to push back against these bets against the yen. And it did have some impact this morning, pushing the yen up against the dollar and away from this low that we saw earlier in the morning. However, the central point that you flicked to there in your question is that if officials in Japan were only concerned about the yen, then you would be expecting Bank of Japan officials also to be helping the cause by talking about looming rate hikes that are going to come and rescue the yen and ferry it back to safer waters in the 140s or 130s. But that is not what we got from the Bank of Japan's most hawkish member, Tamura, this morning, or from the governor. Both of them keep hammering on about the Bank of Japan maintaining easy conditions, easy financial conditions. So we've got a slightly confusing message coming from the policymakers in Tokyo, and this doesn't help the situation of the yen. And part of this stems to the fact that the Bank of Japan has spent more than a decade on this extraordinary program to try and generate inflation, not wipe it out, but to ferment it and get stable inflation. And just when it's got it, it doesn't want to be racing towards race hikes that might, on the first point, wipe out the inflation and also buckle the economy. And we've just had an economy that's just escaped a technical recession.
Okay, so that tension is clearly there. Paul, what are you and the team looking for then in the days and weeks ahead? What could prompt intervention, and what are you outlooking in terms of what's essential for this currency going forward?
Well, I think we're at a bit of a hairy moment here because we do have the holiday weekend coming in, Good Friday, and so we could have limited liquidity in markets, which could lead to big moves that might have to prompt reaction from the authorities here in Tokyo. To me, I do not see them moving before 152. That's when they moved last time, and so that would look like they're protecting a level. So I think we need to see a sharper move that goes well beyond 152 before they take action. If they can get through this weekend and this into the next week, then I think we get into the holding pattern, the waiting game. And the waiting game really is all about the Fed. When is the Fed going to cut rates? Because the cutting speed of the Fed is likely to be much faster than the hiking speed of the BOJ. And that is the key factor that could change the dynamics in the currency market at this point.
Okay, still the essential role of the Fed, of course. Looking at 152 potentially is the next key level for this Japanese currency. Paul Jackson with the excellent context and analysis. Thank you very much indeed. We'll stay on this story at least momentarily and bring in Lilia Peitovin, who is the portfolio strategist at Goldman Sachs. Lilia, great to have you in the studio. Let's start on Japan, because I know you have views on this. The Nikkei up, 50% over the last 12 months. Has the window closed if you want to get exposure to Japanese equities? They're performing well in the session today on the back of cheaper and weaker yen. Does that story continue for the Nikkei?
Yes, you're right. That's one of the views we're having. We're positive on equities as an asset class, and there are some areas outside the US, including Japan, on which we are especially positive. In the Japan, we expect profits to grow more than 30% over the next 2 years, so that's a striking difference with Europe, for instance. And if you look at foreign inflows, which matter a lot for that equity market, they've ticked up, but only modestly. And we've not yet seen, for instance, US investors participating to that rally. So all of this would support probably the Japan equity market higher.
So that's the profit story. To what extent are you thinking about the Japanese yen? How important is that as you factor in your views on Japanese equities? If we have a significant intervention from Japanese authorities, does that give you pause for thought in terms of your optimism on Japanese stocks?
Yeah, you're right. I think Japanese equities make 40% of their sales outside Japan, which is a reasonably high share, lower than what European equities make outside of Europe, but still reasonably high. So we do expect the yen to strengthen, but very modestly, and that should not, really prevent the Japanese equity market from going where we think it will go.
And as we last one on Japan here before we move on to the US and Europe, which segments of the Japanese stock basket are looking most attractive, have the most upside potential from here?
Well, in Japan, as you know, there's the Tokyo Stock Exchange reform, and we have more than 50% of the Japan equity market, which has already disclosed new metrics and outperformed a lot. There still remains the other half of the Japanese equity market, which should do so. So that should be a boost to these stocks. And generally speaking, the market has been very concentrated over there into tech names and AI. The AI theme has been important as well. And just as we think that
should be the case for other equity markets. We think it's time to diversify. Not that we're worried about the current winners, but we do think investors need to diversify their portfolios.
Okay, from Japan to the US, and US stocks still on track for 5 straight months of gains. 5 straight months of gains. Are valuations looking a little stretched to you at this point? Do you need to wait for a sell-off, a drawdown in US stocks before adding?
I mean, you're right. Valuations look particularly stretched, and we mentioned always the fact that the S&P trades on 20.5 times 12 months forward P, which is probably, you know, in the 90th percentile as we speak. But even if you exclude the Magnificent Seven, we are still traded on a percentile which is above the 93rd percentile, so quite high by historical standard, very different from the picture we have in Europe, where valuations have risen as well, but are just below the long-term average. So yes, it's hard to see, the multiple on the S&P going very much higher. That said, our view is that the Magnificent Seven will continue to do well in absolute terms. These are companies which grow 2-3 times faster than the market, if you believe consensus. They reinvest for growth as well, 3 times faster than the rest of the market, which is a good thing for long-term prospects. And they have very strong balance sheets. So in absolute terms, they should do well. Our view is probably that we'll have a catch-up of other stocks in the S&P, which is healthy. And if I look at the previous few weeks, whether you look at Europe or US equities, the rally has been broadening out, which is a healthy thing. And in two-thirds of very narrow rallies, historically, you tend to see a catch-up of other stocks rather than a correction of the aggregate
I just want to bring some breaking news for our viewers, because there's a redhead crossing the Bloomberg terminal right now. This is coming from reporting from Reuters that the Japan Ministry of Finance, the BOJ, and the FSA will hold a meeting 6:15 p.m. local time, so imminently this meeting will be held between the Japanese Ministry of Finance, the BOJ, and the FSA. That meeting coming up, presumably the yen will be a focus of that meeting. Talking of the yen, it has strengthened to 151.29. It is now up 0.2% versus the US dollar. We'll keep across this story, of course, for you and continue to monitor it. Lilia, when it comes to, we've talked about the US story and your expectation that maybe that you see that broadening out even as the Mag 7 remains an essential part of the US equity story. Here in Europe, the valuation gap, do you see that valuation gap between European stocks and US stocks closing, and how does that evolve, that story?
You're right. The gap has never been as large in terms of 12 months forward PE and many other metrics. And I think that there's scope definitely for Europe to catch up a little bit with the US. That said, a lot of that gap owes to long-term, very long-term growth prospects, which owe to the AI theme in particular. And it's hard at the moment.
Is there a real AI theme here in Europe?
Well, it's interesting because there's one metric on which Europe has been traded similarly to the US. It's when you adjust the valuation, the P to expected growth, the PEG ratio. Even on that metric, actually, the US has started to become a little bit more expensive. And if I look into detail, that's been driven by US tech. That's a US tech PEG ratio, which has increased very much.
Lilia, fantastic insights. Thank you very much indeed. Lilia Beitavin, who is the Goldman Sachs portfolio strategist with the insights across these global markets. Thank you very much indeed. Coming up, H&M reporting earnings this morning, coming in with a beat. It's the top gainer across the European stocks picture right now. We're going to get more on that story next. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal. The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Wow.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back. H&M shares on fire this morning, up currently a little over 13%. That's after the Swedish retailer posted better than expected profit in the first quarter following cost cuts and the introduction of a successful new spring range. Let's get more details then with Bloomberg's Jonas Ekblom on this story. Jonas, the inaugural earnings then for the new CEO, and they've come out very strongly. What is your takeaway? Clearly, investors are cheering these numbers.
Yeah, exactly. It's a strong jump compared to the January sales report, when shares instead saw a considerable plunge after the now old CEO left as well. And I think what mostly impressed investors this time around was certainly profitability and margins which was both better than expected, and as well as like another reassuring report for them where they reiterated their double-digit margin target for the year. So.
What is we talked about the new CEO. What is the company's plan then? What is his plan and the management's plan to continue to improve the profitability story at H&M?
Yeah, H&M has always, for the past couple of years, really struggled with really high inventories and higher than average costs when it comes to general admin and just higher input costs as well. So last year they launched a cost-cutting and efficiency program, and they're working really hard to reduce inventory. And in this report, they saw a considerable drop in inventories just over the quarter. So something that is certainly working for them right now. So.
The retail sector, H&M and its counterparts and its competitors, responsible for quite a significant carbon footprint. How is the company working to improve sustainability as a longer-term goal?
Yeah, exactly. H&M is really being somewhat attacked from both sides. You got the more affluent, conscious consumers in the West, where they ask for more, reasonable, sustainability credentials. But then on the other hand, like their incredible core business, the fast fashion, where things move very fast, is attacked from like new upstarts as Shein as well. So they really have to walk a very delicate tightrope walk here, and they're trying new efforts. For example, they launched a new joint venture called Sira, where they recycle polyester, for example, which is a follow-up from like a previous company which sadly failed because they couldn't get profitability.
Okay, Bloomberg's Jonas Ekblom, thank you very much indeed on the context around the earnings beat for H&M. As you can see, the stock is up currently a little over 13%, the leading gainer across the European market today. There's much more coming up. Stay with us. This is Bloomberg.
Trends in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Welcome back now. Japan's Ministry of Finance, the Bank of Japan, and the Financial Services Agency, the FSA, they are holding a meeting right now, according to reporting from Reuters. We are expecting, the press is expecting to be briefed by Japan's top currency official on the back of this meeting. The Japanese yen has moved on these reports. There is a move lower for US dollar Japanese yen. So the yen strengthening by 0.3%, 151.11 now. This follows, of course, commentary, sharp-worded commentary from officials in Japan, from the Ministry of Finance, the Ministry of Finance, the Finance Minister earlier this morning, saying that he would not hesitate to intervene if needed, that they are watching and scrutinizing the weakness in the Japanese yen. We know that's a concern to them. The rate differential, when you look at the US 10-year and the JGB 10-year, that differential remains pronounced, of course. That continues to pressure the Japanese yen. This meeting happening now. We keep across this story for you. Coming up, we'll be discussing how the US and its allies are facing the Houthis. This is Bloomberg.
Was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios, and any given day it would be the head of a studio, and just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it, because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Welcome back. You are watching The Pulse here on Bloomberg TV. Japan steps closer to intervention as the yen slumps to its lowest level against the dollar since 1990. The yen getting a pop, though, on the back of this reporting. The Ministry of Finance, Bank of Japan and Financial Services Agency are currently holding a meeting. That's according to Reuters. From cars to coal, the dramatic collapse of the Baltimore Bridge will cause weeks, even months of transport delays, adding another disruption to global trade. Plus, H&M jumps. The fashion retailer posts better than expected profit in the first quarter. As its spring range draws shoppers, the stock surges. Good morning. Welcome to The Pulse. I'm Tom McKenzie in London. Let's check in then on these markets. We look at US futures and, of course, the European benchmark. After a fresh day of records for European stocks yesterday. Today, though, downside, modest downside across the European benchmark. The Stoxx 600 off so far this one-day session by just 0.1%. The retail story, of course, is pronounced with the earnings beat coming through from H&M. That's on the positive. S&P futures pointing to gains of 0.3%. You are still set for 5 straight months of gains for US stocks, despite the last 3 days and the downside that's come through today. A brighter picture for US equity markets. Nasdaq futures also pointing to add gains of around 64 points, 18,511. Let's flip the board and look cross-asset then. Obviously, the asset at the moment is the Japanese yen. You've seen the strength coming through on the back of this reporting about a meeting that is going on right now. Again, according to Reuters, the Ministry of Finance, the Bank of Japan, and the FSA all meeting right now. We're expecting a briefing after that meeting. But the currency, the Japanese yen, has strengthened on the back of that reporting, up 0.2% at 151.20. But it's the weakness of the currency more broadly that is of concern for these officials. The Brent trading at $85 a barrel, a drop of 1% on reporting around an inventory build-up in the US. We keep across the energy space for you, of course, as well. Let's return now to the Baltimore Bridge collapse and take a closer look at the impact on trade and, of course, the already stretched supply chains in the US, but globally as well. The consequences expected to stretch out for weeks, potentially, and will hit industries ranging from coal to cars. Let's get the details with Bloomberg Markets Today anchor Kriti Gupta. Kriti, where do we stand in terms of what we know about this disaster and the impact economically, Baltimore, the US, and globally?
Well, let's start with the human toll first. So 6 rescue workers will not be rescued, sadly. At least that's the assumption of the Coast Guard, not to be found alive, just given that the water current and the darkness around it that was too prolonged to actually see any hopes of life there. That being said, it is turning from a rescue and search mission to a recovery mission in terms of the actual bodies. That being said, the crew members on the ship were not hurt. The traffic halted on both sides, so a little bit of a human toll escaped there as well. From an economic perspective, we're talking about a lot of rerouting when it comes to the Port of Baltimore. You mentioned it, coal, cars, agricultural products, Deere, for example, using it as kind of the export for a lot of its farming infrastructure and the equipment and machinery that it sends out. That being said, you're now seeing obviously higher rates in the Port of New York, the Port of Virginia Beach as well, which are the other 2 major ports on the eastern seaboard, as well as the West Coast as well. Now, what's important for our European audience is that Port of Baltimore's historic partners have been Germany, the UK, Japan, again, really tying it into that cars and auto-making space. The recovery efforts at the moment, however, in building back the Port of Baltimore seem to be weeks, months, potentially even years, depending on how the funding looks out of the Biden administration.
On the funding question then, the president promising that this will be a federally funded renovation of this bridge. What is your understanding of the politics behind that? Are both sides likely to approve that funding? Is that a simple case of getting the money through Congress, it's going to get approved, and then it gets to the build-out of the bridge, or is it going to be more complicated than that?
You could argue it both ways, and you've seen certainly both rhetoric here. I'll start with the kind of the historic norm, which is that when you do have disasters like these, you do tend to see federal governments rebuild these bridges. Now, this will have an extra push from the Biden administration because, especially ahead of the election and as part of his Inflation Reduction Act, infrastructure has been high on the docket. And that's usually something that's associated with GOP nominees and the GOP docket. So for the Biden administration and Democrats, especially if you're pushing this, is crucial. But also talk about the area that we're in. Remember, there's a lot of union workers in that area. There's the U.S. Naval Academy there as well. President Biden has made multiple statements at the Port of Baltimore as well in terms of really kind of rallying the union crowd. And he himself is talking about how that all fits into the broader picture of really fighting for working rights in this inflationary environment. We should also mention the area is significant because the union, the largest union for some of those marine workers, not only located in that area, but have wage negotiations coming up as well into September. So there's a lot of political factors that certainly feed into this. The funding, it's unclear where it's coming from, but we do know that authorities have said it's going to be a priority.
Okay, Kriti Gupta with a deep dive on the broader implications of this bridge collapse story, of course, in Baltimore. Markets Today anchor Kriti Gupta, thank you. Now, Ford's CFO says the Baltimore bridge collapse will affect its own supply chain. As Kriti was saying, autos clearly impacted by this. He says the company will start to reroute car parts to other East Coast ports.
It's a large port with a lot of flow through it, so it's going to have an impact. It's just at this point, we'll have to understand what that means for us specifically. We'll work on the workarounds. We'll have to divert parts to other ports along the East Coast or elsewhere in the country, and it'll probably lengthen the supply chain a bit.
Okay, we're going to be hearing as well from the CEO of Volkswagen North America later today. We're going to get his view, of course, on the supply chain impact for his business. Don't miss that interview, 12:45 p.m. UK time. Now, the US and its allies have been trying to stop the Iran-backed Houthis, but attacks on commercial and military ships continue. Let's bring in Sylvia Westall, Bloomberg Economy and Government Managing Editor for the Middle East, for the details on this story, which, of course, impacts another part of the supply chain issue globally. Sylvia, how have then shipping companies reacted to the threat of attack in the Red Sea? Is anything that the US and its partner, the UK, doing militarily helping to assuage and reassure those shipping companies?
Yes, I mean, we've seen a complete change in that global shipping route. People are now going around southern Africa. It's putting, 2 weeks on top of the normal time for freight to move through the seas. And even though there is this mission led by the US to act as deterrents in these waters, there's warships, there's heavy equipment, there's this coalition of vessels in that area, the attacks are still continuing on commercial vessels. And so that means that companies have to make the choice, do they sail through it or not? The CEO of Hapag-Lloyd, the German company, said in an earnings call earlier this month that it's a binary choice. Either it's safe for their people to go through these waters or it is not. So companies really have a yes or no option. So even if, to some extent the US is saying that they have been able to degrade the Houthis and the attacks they're able to carry out, if there are still events happening, then global companies do avoid there. And this is a really important area. I mean, it was carrying around 15% of global commerce, and we've really seen a big rerouting of that traffic now.
What is the outlook then, Sylvia? What is the expectation from shipping companies, from the militaries of the US and the UK, as to how long this goes on for, how long this disruption is going to have to be baked into some of these decisions?
Well, one of my colleagues, Peter Martin, was recently on one of the US vessels, and there was a discussion about this taking months. They're preparing for a long haul. If you look at some of the global company expectations, some of them have revised their expectations for freight costs throughout the rest of 2024, and some are saying that this could carry on until 2025. So in terms of how long this is going to impact, it's going to take several months, if not toward the end of the year, at least if you talk to companies and people who are involved in these missions to protect these waters.
Okay, Sylvia Westall, really important reporting coming from Sylvia and the team. Bloomberg's managing editor for economy and government in the Middle East, Russia and Africa. Thank you. Coming up, US business leaders, including Blackstone's Stephen Schwarzman, meet the Chinese President Xi Jinping in Beijing as the nation tries to restore confidence in its economy. Will the charm offensive work? We have the details. This is Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words and then you put a few sentences together, and one day, you might be able to write poetry.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
Welcome back. Now, shares in China's BYD, the world's top-selling electric car maker, closed more than 6% lower after posting a small earnings miss. The lackluster performance stands in contrast to some of its smaller competitors in the country's highly competitive EV market. Let's bring in then, for the context, Bloomberg's global auto editor, Craig Trudell. Another line crossing out of the auto market of China. This NIO coming through. The ADR is falling 3% after cutting their first quarter delivery target. So just building out that picture for us, that there is softness now coming through for the EV story in China. BYD, of course, the biggest player in China, the biggest player globally, Craig. What do you make of the earnings story from BYD? What does it tell us more broadly about the demand for these autos?
I like your emphasis on small, because the miss here was a very slim margin. And after all, it was also, this was a company that had released preliminary results weeks earlier. And so it really wasn't vastly different from the range that the company had already given. But I think it did just sort of, reinforce these concerns that have just been building month after month, that there is an EV slowdown, that this company is prioritizing sales growth over profitability. We saw this trend last year that they were building deliveries quarter by quarter, building profit along with that, but that broke down in the fourth quarter. And we're just seeing sort of signals that the company is sending to the market that they're okay with plowing ahead with that they're putting emphasis on 20% growth forecast for the year, They want to keep growing. They're not interested in sort of backing down and sort of, going along with this idea that, the consumer is pushing back a little bit.
Okay, can we expect the Chinese government, Chinese officials saying they want the consumer to be able to have the scope to buy and replace products? Cars are part of the mix. Are we expecting any response from regulators, from officials in China to help, whether it's subsidies, to kind of spur this market? And tying into that question, the export market now for Chinese companies like BYD, increasingly important as they kind of push overseas. Those two elements as we look ahead then for how this evolves.
Yeah, the government is kind of caught between a rock and a hard place here, because on one hand, it's trying to fight these battles with the EU and the US over, the subsidizing of its market. If it, sort of comes to the rescue, kind of undermines the argument that it's mounting as of yesterday with the WTO, with the US, with the EU, tariffs are on the way there as a result of the anti-subsidy investigation that was launched last year. They also have this situation where they still probably have too many manufacturers in this space. NIO is just the latest of the smaller players to come out with softer numbers and sort of downplay how many sales it's going to have this quarter. And so, does there need to be more consolidation here as opposed to this constant kind of coming in and coming to the rescue of these companies that are underperforming and not executing? And that's the question.
Really, really important story, and the context always excellent from Craig Tudor. Thank you very much indeed, of course, who leads our autos coverage across, of course, Bloomberg, with the context on that story, BYD, but a much broader story evolving as a result of that. So let's get back to the lines crossing when it comes to Japan and the yen, of course. We have had this meeting, it was reported by Reuters. The meeting, it seems, has concluded, a meeting between the Bank of Japan, the Ministry of Finance, and the FSA, the Financial Stability Authority, and a speaker now coming through from the Ministry of Finance, Masato Kanda, speaking after that meeting, saying they cannot tolerate speculative moves in the FX market. Kanda saying that 4% FX moves in 2 weeks are not moderate. They are not ruling out any options regarding Forex. They are watching Forex with a high level of urgency. Kanda of the Ministry of Finance of Japan saying they are seeing clear speculative moves in the FX market in Japan. Kanda saying that the US-Japan rate differential is narrowing and confirming an economic virtuous cycle in Japan. But the key lines are they are re-emphasizing their willingness to monitor and potentially intervene. We are always prepared, says Kanda, to address abnormal situations. 151.27 on the Japanese yen, strengthening 0.2%. We continue to watch this story for you. The briefing on the back of this meeting between the Bank of Japan, the Ministry of Finance, and the FSA. We continue to maintain readiness to act as usual. So far, it's the jawboning that continues from Japanese officials. But as we've been reporting, and our team in Tokyo have suggested, 152 is probably the line in the sand for officials. So currently 151.30. We keep across this story for you, of course, throughout today's programming. Now, China's President Xi Jinping has met with US business executives in Beijing, including Blackstone's Stephen Schwarzman, a regular to Beijing, and Qualcomm's Cristiano Amon, as the nation looks to shore up confidence amid a slowdown in foreign investment. And that slowdown last year was pronounced. Global business leaders are also gathering at China's annual Boao Forum in Hainan, the Asian version, some would describe it, of the World Economic Forum in Davos. Bloomberg's Lucille Liu joins us from Beijing, though, with the details, not enjoying the tropical climate of Hainan. Lucille, what are other executives attending the meeting? What have they been saying? How significant is that meeting between US executives, foreign executives, and the Chinese president?
Hi, Tom. Yeah, that's right. We've been hearing a lot about this meeting leading up to this week. Of course, there was the China Development Forum just over the weekend. A lot of these CEOs were at that forum. And of course, we're also seeing a lot of these CEOs were at that San Francisco dinner back in November when Xi was at the APEC summit. So a lot of people are describing this sort of as a continuity of that stabilization of the increased dialogue. And of course, at this meet, Xi did tell this group of CEOs that, invest in China. And he also talked about the domestic economy, saying, China hasn't collapsed because of the China collapse theory, and it's not going to peak because of the China peak theory. So, just striking a confident tone for the economy and on U.S.-China relations, talking about this stabilization.
And Lucille, I know you've been covering the BOAO, the forum. Well, there's the BOAO forum, of course, but you're also covering the China Development Forum. Tell us about what you've been hearing at both of those events from business executives. Is it your sense, speaking to executives, Lucille, that they are now regaining some level of confidence in the Chinese market?
Well, I think the main thing is that executives don't invest because things are good for 3 months, 4 months, 5 months. You know, they're looking at a couple of years. And of course, we have that upcoming election in November. And so, you know, it's hard to say if this is the calm before the storm or if this is going to be some sort of stabilization that's lasting. And so, I mean, executives definitely are striking a very positive tone. We had Tim Cook in Beijing, you know, saying how much he loves China and the Chinese people, how dynamic it is here, really talking up the partners and suppliers. Many other CEOs as well, you know, praising China for some of its recent moves. But again, they're speaking to the domestic audience. They're speaking, you know, they're trying to help their local teams here, kind of build business. So, you know, it's been a lot of praise, but it's hard to know if this is lasting.
What are you watching for, Lucille, you and the team, between now and those US elections in November? On the policy front, in terms of what could move the dial, in terms of the relationship between Beijing and Washington, or on the economic front, in terms of additional policy to support this economy?
Yeah, absolutely. I mean, I think we had that speech actually from Li Qiang at the China Development Forum where he, you know, talked about Chinese manufacturing. He talked about sort of this drive. And of course, people were asking, well, where are the sort of demand side aspects of this? And so I think that's a big thing people are looking for. Are there going to be more demand side drivers, or is this a doubling down on manufacturing and that's it? We're certainly looking forward to see if the third plenum will happen, as they, you know, often announce economic reforms. And of course, today Xi did say something to the U.S. CEOs. He said, you know, China is implementing but also planning major reforms, and so that could hint at something. But of course, it's hard to tell. And so we're definitely looking to see if there is any shifts in policies or new stimulus or anything to boost consumer confidence.
Okay, Lucille Liu, thank you very much indeed in Beijing on the latest the BOAO Forum, but also the China Development Forum and the importance of these meetings between US and foreign executives with the Chinese leadership. We appreciate it. Coming up, former President Donald Trump's social media startup has added billions to his fortune, at least on paper, but legal strains still threaten his finances. We'll get the details. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal?
The Deal?
The Deal.
The Deal. That deal. The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Welcome back now. Former President Donald Trump's social media startup gained 16% in its first trading day as a public company. The newly public company has added billions to Trump's fortune, at least on paper. There's a lot of lockup deal and detail in that. But legal strains still threaten his finances. For the details, I'm joined by Bloomberg's Charlie Wells, who's been covering this story for us. Charlie, Donald Trump then richer than ever on paper, but still facing quite a momentous and significant legal fortune as well. Legal financial hit, I should say.
Yeah, I mean, the past few days have been kind of characteristically Trump in that there's sort of, too much, but also never enough, to quote a book about him by his niece. And look, he got a boost on paper, particularly from DJT, Trump Media, which kind of backed into a SPAC. He's got $4.6 billion coming from the value of those assets right now. And so his, worth is now $7.2 billion. That landed him on the Bloomberg Billionaires Index. Those are the assets, but he's still, as you mentioned, got significant liabilities. He got a bit of a reprieve in some of these legal liabilities this week. A bond was reduced in a New York fraud lawsuit from about $500 million to about $175 million, but that's on appeal. And so the issue is if, he loses the appeal, if that verdict stands, he could still have to pay about $500 million. He could still have to pay about $83 million in another lawsuit, and he also faces 4 criminal lawsuits, 2 about allegedly trying to overturn the U.S. election. And so, yes, boost in assets, but still legal liabilities mounting.
Okay, Charlie Wells, thank you very much indeed on the fortunes. The mixed fortunes then, of course, of Trump, former President Trump, and of course the nominee for the Republican Party for that November vote. Charlie, thank you very much indeed. Let's get back to the story around the Japanese yen then. We've had this meeting between the BOJ, the Ministry of Finance, and the FSA in Tokyo, of course. We've had some details on that in terms of their attempts to put something of a floor under the Japanese yen. Let's bring in Bloomberg's Ven Ram from our MLive team, who's been writing about this on the MLive, on the Bloomberg terminal, on Bloomberg.com as well. Ven, what is your sense as to whether or not the goals and the targets of Japanese officials around the Japanese currency are being achieved with this jawboning? 151.33 on the Japanese yen right now.
No, I think the jawboning is falling short of what the market expects, Tom. Clearly, I mean, we went into this meeting with the yen completely misaligned with fundamentals. And for them, at least the initial sound bites that we are hearing from the MOF for that, the currency is deviated from its fundamentals. 4% moves in the space of 2 weeks is overstated and all that, which is very well known and acknowledged by the markets. So for them to go into a special huddle and come up with more of this verbal jawboning means that, they are not really taking the speculators head on. And that will only strengthen the hands of the speculators, play into their hands. And that means that the yen will quickly give up those gains, those fleeting gains that we have seen in the past half an hour or so, and then go back into losses. The yen needs a lot more to recover from here.
Really important context on this big day for the Japanese currency. Ven Ram from our MLive team, we appreciate it. Surveillance is ahead. This is Bloomberg.
Let me ask you about politics. You've been involved advising presidential candidates, I presume presidents as well. You ever have any interest in serving in a senior position in the federal government or running for office?
Absolutely, unequivocally, no.
The aggravation factor isn't worth it?
It's the aggravation factor, but it's more importantly is I don't believe there's any integrity in it.
So you do give money to politicians, though, because that's the system, but you...
It's part of the game. I think, to be honest, I think there's a need for a multi-party system in the U.S. to give more people a choice about where they can throw their voter support and their political support, but also to cause the country to sort of come together by having everybody have a role in deciding what is in the long-term best interest of the country. I've often believed that Black Americans as a people and as a voting bloc should adopt the same position that the original founders of the Congressional Black Caucus had in early 1970. Their philosophy was enunciated like this: Black Americans should have no permanent friends, no permanent enemies, just permanent interests.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Central bank policy, particularly with regard to the Fed, is very, very binary. They either cut or not.
They don't need to wait for inflation to come all the way back down to 2% to actually start cutting rates. We just need to be confident that things are evolving in the right direction.
They're kind of trying to tell us that we're on a path to get to rate cuts now. Inflation has come down enough that they think that they can be cutting interest rates.
We can still get 3 rate cuts despite some of the hotter inflation data.
They're trying to play the waiting game. Eventually, they're going to have to suppress the front end.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. Your equity market on the S&P 500 positive by a third of 1%. 3 very mild days of losses behind us. Let's see if we've got a day of gains in front of us. In front of us this hour, expect plenty of updates regarding the Baltimore Bridge collapse. Lisa, finding out just how bad it was and how much worse it could have been.
Especially if we hadn't gotten that Mayday call from the ship that prevented more cars from entering the bridge. Honestly, I was watching the video on repeat last night. And again, the question just remains, how could a bridge just collapse like a couple of toothpicks? That's what it looked like in the imagery. What else are the vulnerabilities that we have out there, and how long is it going to take to work through all of this?
In a matter of seconds as well, Bramo. Just absolutely stunning pictures for us all. I think the team here at Bloomberg still tracking the disruption. AMH working through 2.5 million tons of coal, cars made by GM, Ford, lumber. The list just goes on and on.
Yeah, when you think about this port, it is what they would call a second-tier port, but because of where it's located, it is incredibly important for cars. It's inland, it's close to all these railroads. Think about all these cars going to, say, Detroit. And then when you think of agricultural manufacturing, trains that can go to Chicago, and then, of course, an export for coal. Everyone is working through what this means, but Anna Wong of Bloomberg Economics says 0.2 percentage points potentially could be a base case higher for inflation, given the disruptions at this port. And Pete Buttigieg and officials are saying this is going to take a lot of time, and it's going to take a ton of money.
To me, it's also this sort of another test on top of tests of what happens when you start to reduce some of the capacity. How much do you get clogged up ports in New York, in New Jersey, in Virginia, if you do get that sort of redirected traffic? Is this sort of a much smaller scale pandemic-type supply-side disruption 2.0, or is this something that's completely different on a much lesser scale?
Kelly Lyons is going to break break down some of the headlines for us on the ground in Baltimore in about 10 minutes' time. I want to turn to financial markets just briefly. One currency pair jumps out this morning. It's dollar-yen. Let's talk about some levels in dollar-yen. So October 2022, we're talking about 151.95. Japan intervenes. Overnight, 151.97 on dollar-yen. Bramo, and this is what happens. Literally hours later, a meeting between the Finance Ministry, the Bank of Japan, and the Financial Services Agency, and the headline coming from a top currency official in the Finance Ministry is, "We will take appropriate action against excessive moves. We maintain the readiness to act as usual, and a 4% move in 2 weeks is just not moderate." Now, that's the verbal intervention. We've heard that 3 times now, twice today, once in the last week. Is that going to be enough to move this currency market?
The answer is in the currency market right now, not yet. It feels like traders are thumbing their nose at the Bank of Japan right now and saying, really, this is all you've got? You're getting a little bit of a retracement of some of the weakness, but still we're close to the 34-year lows that we really hit overnight. You have one Bank of Japan member coming out and saying that the central bank must proceed slowly and steadily toward normalizing its ultra-loose policy. That's what triggered this. And then authorities come out, we'll take really serious actions. We have no idea what those actions are, and they haven't really shown a willingness to flood the zone in the past couple of months.
You go from negative rates to zero. It's your first hike since 2007, 17 years. And then you come out and start complaining about speculative moves behind a weak Japanese yen. Is it really just speculative moves behind the weak Japanese yen?
I'm not to say. They can speculate all they want about the speculative moves. I think a lot of people are looking at this and saying you've got inflation that's really coming back in Japan for the first time in a very long time, and you've got otherwise very easy monetary policy. Put those two things together, the currency move is pretty obvious. So, you know, call it speculative, call it whatever you want. How they're going to address it really is the issue.
That verbal intervention, this is what it's worth. 151.33. We're negative on the session by 0.1%. That's how much things have moved off the back of some of that chat. We'll pick up on that in just a moment. The broader market looks like this. Equity futures on the S&P 500 shaping up as follows. Futures at the moment positive by 0.4%. Yields basically unchanged on a 10-year at 423.76, and the euro going absolutely nowhere. Euro dollar 108.27. Coming up this hour, Marvin Lowe of State Street as the rally takes a pause for a third straight day. Bloomberg's Brendan Murray on the Baltimore Bridge collapse, and Bruce Kassman of JP Morgan on America's rising debt pile. We begin with our top story in this market. The equity market rally stalling for a third consecutive day, ahead of comments from Chairman Powell and core PCE to round out the week. Marvin Lowe of State Street saying this: "We will see rate cuts starting in June. Most will be justified based on falling economic activity. The Fed is still an outlier given growth and inflation performance to date, but it's clear that there is a fairly high hurdle for the Fed not to start the cutting cycle." Marvin Lowe joins us now for more. Marvin, good morning to you.
Morning.
Just how low is that bar for that first cut from this Federal Reserve?
You know, they want to cut. It's pretty low, kind of just based on where data is and probably what they should be saying around that data, but for the most part saying they're going to ignore the data. So they want to cut. There's an election cycle that kind of gets into play with this, and you know, they still firmly believe that policy is restrictive. To me, it's a function of how much they can cut, and I think even though they pulled back on their expectations, you know, they might be surprised how sticky inflation is.
It doesn't really matter what they say. We've just had this equity market rip. 5 consecutive months of it. We've heard the complaints. RBC has talked about it being stretched. Evercore yesterday on this program called it exuberance. I think Academy, Peter Cheer was talking about taking out downside protection. Why do you think now isn't the time to fade this strength?
You know what? Because we've got a lot of central banks that are lining up for really the start of releasing the hounds, if you will. If you kind of think about a market that's expecting 3 or 4 very large central banks to start cutting in June, and then the modal aspect of that where you get these quarterly expectations for the next year to year and a half, all of a sudden you've got several hundred basis points of cuts in portfolios that are all going to benefit from that.
Marvin, yesterday's trading action did remind me of Peter Scheer's conversation, and it's something that he may or may not have pinged me on and said, see, this is exactly what I was talking about. A thin liquidity kind of moment. Yeah. The fact that you could see a sort of sell-off into the close in a sort of unprovoked way. How do you trade around a lack of conviction and really thin liquidity with the appearance of trades leading to sudden moves for no reason?
Yeah, I mean, it certainly is a challenge. If you're in that world, certainly taking a protection around is how you approach it. I'm more of a intermediate long-term investor. I look for fair value, and I ultimately just sit through it and expect kind of that story to play out. We are going to see several hundred basis points of cuts around the world over the course of the next 6 months. We do have liquidity that's still fairly robust making its way into the system. And we've got the Fed talking about slowing down QT at a time when reserves are still quite high. All of that to me is still a relatively positive story for risk assets.
Do you add then to risk assets? Do you say, okay, it's time to lean in even further because it's unclear what could potentially disrupt this?
I wouldn't be leaning in heavily. I'm more, for the most part, we've all added to our portfolios over the course of the last 6 to 9 months, hopefully, and that's put us in a fairly positive position. I think I'm looking for potential changes to get my portfolio into a better position, if you will, up in quality. If we're talking about credit, potentially looking at parts of the growth equity story that get me more comfortable, but adding aggressively in here is hard. I'll admit to that.
Let's talk about verbal intervention. Started the week with it from Japan. Yeah. It continues today and overnight this morning. We get more comments. They're going to take appropriate action against excessive moves, they say. Dollar yen is still through 150. For you in this market, when you hear words like this, what does it mean?
You know what? It's a bit of a paper tiger, ultimately. They laid the groundwork in terms of how to think about their policy when they dovishly hiked to zero. The rate differentials around the world still remain fairly robust. I think when you have a very low volatility world that we do in FX, and we're always looking for the carry trade, you've got another potential funder that, since they've taken out kind of that big gap from the perspective of if they actually aggressively approach policy, which they didn't.
Do you think that it was a mistake then that they insinuated that financial conditions were going to remain easy?
I don't think they needed to. I don't think they needed to ultimately. And I think that they probably should have gotten more clarity in their mind in terms of when the cutting cycle was going to begin. They waited for so long, ultimately. If they hiked while everyone else was cutting, it would certainly make the interest rate differential story a bit easier. I guess hindsight being 2020, I don't think they need to be as dovish as they are.
Do you think the story is specific to what's going on at the BOJ or also what we're seeing from the Fed?
The Fed is a story that every central bank follows. The Fed is a story, for better or for worse, given kind of how the dollar's role is in the capital markets, is important in that discussion. So yeah, it's twofold for sure.
At this point, we were talking a lot yesterday about the potential for ongoing Fed intervention to offset some of the bills for the U.S. government. Yeah. And this raised questions about a longer-term weakening in the dollar, especially as people realize, okay, the U.S. is going to try to inflate its way out of its debt issues. How much do you see that as a long-term trend that you can actually bet on?
Yeah, I think that overall term premiums are too low in the market. I think that you've got a lot of things coming together, whether it's the debt level, whether it's the amount of bills, and whether or not kind of the Fed could get to its 2% inflation target. Inflation volatility and all of those aspects equal some challenges at the long end of the curve. So really thinking about bear steepeners later in the cycle is something that I've been spending time on.
To put this whole conversation together, how much are we looking at a moment where bonds are the risk asset and stocks are actually a haven, in the sense that they're more hedged to the growth and the potential stimulus that's coming from all sides, whether it's fiscal or whether it's monetary?
Yeah, for sure. Earnings are nominal, and if we were to kind of break down the market, the U.S. growth aspects remain the strongest in the world.
Marvin, one other final thought on the events of yesterday, if we can. If you sever an artery in global supply chains, no matter how small it might be, relatively speaking, it can have global consequences. Given the challenges to goods disinflation in America, what was your reaction to what happened yesterday in Baltimore?
Ultimately, I rely on your reporters and your folks to kind of get me educated on this for sure. But it doesn't make it easier. At a time when the Fed needs to see the continuation of these disinflationary trends that somehow took a pause over the last couple of months make their way back in the market. They've got some hard decisions to make in the next couple of months, and this doesn't make it easier.
We'll see how big the challenge might be. Marvin, thank you, sir. It's fantastic to catch up. Marvin Lowe there of State Street. If you are just joining us, Lisa, equity futures right now at the S&P near session highs. We're positive a third of 1%.
Let's get you caught up on some stories elsewhere this morning. The search and rescue operation after the collapse of the Francis Scott Key Bridge in Baltimore is now a search and recovery mission. A road crew was working on the bridge at the time of the collapse. 2 people were rescued. 6 remain unaccounted for. The area remains closed to traffic, cutting off a major artery around the city. Japan has stepped closer to currency intervention, as we were just talking about. The country's finance minister ramped up hints of possible action, maybe, after the yen touched its lowest level versus the dollar in 34 years. Policymakers, they were kind of running out of choices short of purchasing the currency to prop it up after the Bank of Japan's first interest rate hike since 2007 failed to change the yen's trajectory. Shares in Chinese EV maker BYD closed the day more than 6% lower in Hong Kong after an earnings miss triggered its worst sell-off in 7 months. China's largest electric vehicle maker missed its 2023 earnings estimate by $138 million, raising questions over whether it can sustain strong profit growth amid a pretty intense price war. The company almost tripled its final dividend payment, but that was not enough to allay investor concerns. And that is your Bloomberg brief, John. Honestly, to me, it raises this question whether the whole EV trend, regardless of the region, really is under pressure in many ways under their own doing with a price war, but also just with respect to demand.
I was thinking the same thing. This is supposedly the market leader.
Exactly.
Also included in the race to the bottom for these names. This is a massive struggle in this space.
And it really bodes maybe a little bit ominously about how close people are getting to questioning whether this is truly the next step and how quickly we can get there.
More on that story a little bit later. We'll be catching up with officials from VW and Nissan as well. Up next on this program, Biden vowing federal support for Baltimore.
I told them we're going to send all the federal resources they need as we respond to this emergency. I mean all the federal resources. And we're going to rebuild that port together.
That conversation up next, live from New York City this morning. Good morning.
Was going to keep reading World Cup. This is a three as the economic picture covering the intersections of Hollywood, Silicon Valley, and beyond.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Trying to bounce following 3 days of very mild losses on the S&P 500. Equities up by 1/3 in the bond market. Yields just about unchanged. Your 10-year, 423.56. Under surveillance this morning, Biden vowing federal support for Baltimore.
I told them we're going to send all the federal resources they need as we respond to this emergency. I mean all the federal resources. And we're going to rebuild that port together. Everything so far indicates that this was a terrible accident. At this time, we have no other indication, no other reason to believe there's any intentional act here.
Here's the latest. Search and rescue efforts suspended, with 6 individuals unaccounted for after the collapse of the Francis Scott Key Bridge in Baltimore. Maryland lawmakers pushing for an aid package to help rebuild the bridge, with the president saying he'd work with Congress to fund it. The collapse expected to cause weeks or possibly even months of disruptions. Bloomberg's Kelly Lyons joins us now for more. Kelly, you've been at the scene now for the last 24 hours or so. What's the latest on the ground?
Well, as you say, John, the search and rescue operation was suspended around 7:30 p.m. last night and starting at 6 a.m. today, so really just moments ago, according to Maryland authorities, the Maryland State Police, together with their partners, are beginning now the recovery efforts. This is now going to be about actually finding the bodies of these 6 unaccounted for individuals, construction workers who were on the bridge working on potholes at the time of the collapse. It really right now is an effort to try to provide closure for some of those families affected. Of course, that isn't all that will go on today. We could very well see the National Transportation Safety Board, the NTSB, actually board this vessel, the Dolly, today. They did not do so yesterday as they didn't want to interfere with the search and rescue efforts, which were the #1 priority at that time. But they could begin the work today of the actual investigation. They're going to have a 24-person team investigating this, looking at the recorders on the ship, trying to figure out what exactly happened with this crash and what role the owner or operator may have played in any of this. And then, of course, it's going to be a matter not just of investigating, but actually trying to get the ship itself out of the harbor and start being able to clear some of the debris from the shipping containers that fell off the ship, as well as from the bridge itself, which, of course, is in large part submerged underwater as we speak, trying to get all of that cleared out so that the Port of Baltimore can reopen. Authorities here, though, have been very reluctant to put any kind of timeline on just how long that might take.
Kaylee, in the meantime, and our thoughts are very much with the families of those 6 individuals, I am wondering, in the meantime, where traffic is being diverted, what the scene is like, what the plan is, especially given that this is a main thoroughfare, both for trucks but also for commuters.
That's absolutely right, Lisa. Roughly 35,000 commuters every day were crossing this bridge to get to where they're going. And obviously today, they will not be able to do so. There was heavier traffic during rush hour last night, and today will be the first real test of morning rush hour, as these drivers will not be able to use I-695. Instead, will have to divert to other routes, including I-95, 895 as well. For commuters, that may mean more traffic on the way to work, but for transit, the actual freight that was moving over this bridge, some 49,000 commercial vehicles, or 4,900 rather, commercial vehicles use this every day as well. If it was containing hazardous material, they are not allowed to use the tunnels that go underneath Baltimore Harbor. So their transit period could be much longer. Tens of miles being added to their journeys is realistically what we are talking about here. And that is really why reconstruction of the bridge after the port is reopened and the channel has been actually cleared, reconstruction efforts are going to be key to releasing pressure in this very vital artery in terms of transit here in the Mid-Atlantic. But that is a timeline that could be incredibly long and incredibly expensive. We heard from the Transportation Secretary, Pete Buttigieg, who was here on the ground at the scene yesterday. He said this will not be quick, this will not be easy, and he said it will also not be inexpensive.
This is going to take time and a lot of money. Hey, Katie, great work over the last 24 hours. We'll catch up with you a little bit later this morning. Need to talk about global trade with our resident trade expert, Bloomberg's Brendan Murray, who joins us now for more. Brendan, let's talk about how easy it is, or not, to shift cargo to other East Coast ports. I'm thinking Boston, Miami. How straightforward is that, Brendan?
It's not a hugely complicated process, and in fact, we're already seeing ships go to ports like New Jersey, New York, Virginia, and places like Savannah. This morning, you can see those ships already gathering outside other ports that have been diverted from Baltimore. The problem comes in with each one of those containers or the shipload of commodities. They need another source of ground transportation. So that's where the complication comes in, and we're talking about thousands and thousands of containers and thousands of tons of goods and lots of cars. Baltimore is the country's busiest port for auto imports and exports, so they're going to have to find some other way to go through. Some of the car companies, we understand, have their docks on the ocean side of the now collapsed bridge, so they might not be affected. We're picking through some of those details right now, but certainly the auto industry is one of the more disrupted ones from this tragedy.
GM and Ford already saying they're rerouting to Georgia. Out of all these East Coast ports Jonathan mentioned, who is most prepared when it comes to the auto industry, given how important and critical Baltimore was for auto vehicles?
Virginia is one of the names, one of the ports that you hear talked about frequently. Brunswick, Georgia, is another one where lots of vehicles flow through. In the southeast, there are a number of European car makers have their facilities there. So that services a number of European imports and exports. So that's what we're seeing. The bigger vessels, the ones with more than 12,000 containers, some of those more southerly ports aren't deep enough to handle those big vessels, so they're going to wind up in New York, New Jersey.
Looking a little bit more broadly, how vulnerable is the entire supply chain industry right now? You see what's going on in Panama, we had the disruptions in the Red Sea, and now we have a pretty critical port on the East Coast down.
Most of the folks we talk to are cautiously optimistic that this is not going to be a huge. It's going to have a huge impact on the national economy. It will certainly affect the region for weeks, if not months. But we'll have to watch and see. We saw 10%, 20% more cargo coming into the ports of Los Angeles and Long Beach during the pandemic, and the bottlenecks, grew and grew and grew for a year or longer. So we'll have to keep an eye on whether these are just sort of isolated choke points that get resolved and ironed out pretty quickly, or whether it's sort of the domino effect that we saw just a couple years ago.
Exactly to that point, Ryan Peterson of Flexport yesterday was saying that essentially this is really the test. Whether or not a sudden 10 to 20% increase in some of the volumes at places like New Jersey and New York causes the same kind of hangups. What makes people optimistic that we're not going to see those types of backlogs that were really problematic for a lot of different companies during the pandemic?
Yeah, the U.S. economy is solid right now, but it's not going gangbusters. So there is some capacity in the logistics industries that we cover, shipping and trucking and rail. There is some of these ports are running at something like 70% capacity, whereas during the pandemic they were at 100%. So there is some flex in the system to deal with this. There's also the sort of wild card in all this is the dock workers on the East Coast have a contract negotiation this year. So they're going to become very important. The workers at the East Coast ports are going to become very important to making sure these goods flow smoothly. And maybe perhaps this gives them a little bit more leverage in those talks.
Brendan, what do you think the template is, the lesson from the West Coast negotiations for what's about to happen on the East Coast?
Well, I think as I said, the dock workers, now the spotlight is going to be on them to see if there's enough labor even to handle all these diversions. So it looks like there's a lot of big talk during negotiations like this, lots of threats coming from both sides. But it sounds like heading into the November presidential election that they can't the parties on all sides can't afford to see a strike where the East Coast ports shut down. So it sounds like they're going to try to resolve it rather than have it become yet another supply chain disruption.
Hey, Brendan, appreciate your time this morning. Thank you, sir. Brendan Murray there of Bloomberg out of London. Was reading some of Brendan's work yesterday, just the uniqueness of Baltimore's port for coal. This is what jumped off the page to me. The second largest terminal for U.S. coal exports. And the shutdown of this, and we don't know how long it's going to go for, weeks, months, potentially hitting shipments to India. And this goes back to how we started this hour. You can get a severed artery, no matter how small, and the global implications take a while to sort of figure out the disruptions.
As people try to figure out where else is coal going to come from to places like India. Also, I was reading, what jumped out of the page to me was some of the farm equipment and construction at a time that's crucial for planting things now. This is one of the main arteries for all of the tractor trailers. To your point, there are very specific industries catered to in specific arteries, and if they get severed, how quickly can they be adjusted elsewhere, especially given some of the extra costs involved?
The coverage continues this morning on Bloomberg TV. Up next on this program, Bloomberg's End the Current as China's president looks to mend ties with American CEOs. That conversation up next. From New York City, equity futures near session highs, positive 0.4%. From New York, this is Bloomberg.
trends in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on their phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Stocks near session highs. Welcome to the program. Equities up by 0.4% on the S&P. Just a few days of losses, really mild marginal snuff. Once again, when you see some outperformance, we saw this last Wednesday, didn't we? Following Chairman Powell, the outperformance starts to come from small caps. We'll see if this sticks. The Russell, Lisa, up 0.75%.
If you look at the correlation between expected rate cuts and the Russell 2000, it's getting closer and closer. It seems like people believe the smaller companies are much more leveraged to the cutting cycle and will benefit that much more from some easing.
5 months of gains on the S&P 500. A couple of days left of March. Can you believe that? Q1's finally over. You happy with that?
No,
It's
yes, but it feels like
Q1
it's
feels
two
like
quarters.
I'm with you. It feels like the first half, doesn't it?
I mean, how many narratives have we been through? We've talked about the idea, are we data dependent or does data not matter because they're just going to cut anyway? Are we talking about a Fed or are we talking about NVIDIA's cycle? Are we talking about the death of the mega caps? Or are we talking about the Magnificent Two? I mean, these are some of the narratives that have kind of percolated out with no resolution for the first quarter.
I'd say this, I think we've seen just as many narratives in this quarter as we did last year, but they're changing more quickly. So last year, for the whole month of March, it was hard landing talk, right? Regional banking issues. This time, what did that last? Couple of days? NYCB stock up and down, maybe some mutterings of hard landing, but no one really bought into it anyway.
Bear with me. It feels like people are just exhausted by it.
Sure.
And so they sort of half buy into it, don't really have any conviction, don't really trade that greatly, and then just sort of hope for some sort of shift that they can get excited about.
You're convinced everyone's bored right now.
I've heard that directly from a number of traders.
I know.
You know, look, if someone's very excited, please reach out to me, and I want to hear it, and I want to ride that excitement.
Let's get to the bond market, 2-year, 10-year, 30-year. There's nothing exciting about this. Really muted price action. We said this yesterday. It's like depths of summer price action in some places. The 10-year, 423.56. The 2-year, 459.51. If you want a bit of price action, look to Japan. Authorities all over the place. I'll give you the score and I'll get to the story in just a moment. Dollar yen, 151.16. That currency pair is negative 0.25%. That is the smallest. Teats wince. Is that what TK would say?
Yes,
Teats wince.
correct.
The tiniest bit of yen strength against the US dollar.
Because there might be intervention. They will take strong actions after seeing their currency weakened, lowest going back 36 years. At a certain point, they have to come through with something. And how much conviction do they really have behind trying to bolster a currency when it's clear that their central bank has no interest in tightening policy materially?
The dollar yen, 151.18. Under surveillance this morning, 6 workers are presumed dead after yesterday's collapse at the Francis Scott Key Bridge in Baltimore. Authorities have yet to offer a timeline as to when operations will resume as officials look to remove debris and the cargo ship Dali from the entrance to the city's port. Businesses are diverting cargo along the East Coast in the meantime. The port of Baltimore is a crucial stop for European car makers and US exports of coal as well. There's 2 dimensions to this story that I think are worth exploring right now. There are many, but here's two. One is how much worse this could have been, and the second piece of this is liability. I remember yesterday we were all talking about this. We wanted to understand the time between the Mayday call and the collision, and Governor Westmore gave us some colour on that. Basically said this, Lisa: we're thankful that between the Mayday and the collapse, we had officials that were able to begin stopping the flow of traffic, which just gives you a sense of how much worse this could have been yesterday. Never mind the time it happened. I mean, you think about rush hour. This could have been seriously tragic.
I was watching the video, as I said, on repeat, which I probably shouldn't have done, but I was watching it, and I was just, every car that was going across in the 10 minutes before, I was like, don't go, don't go. And you're just so grateful that a number of them didn't go right before the collapse. At a certain point, we're talking about coverage that might go up several $billion for the ship, but this needs to be immediate. How do you get immediate financing to the whole region to start the reconstruction effort that took 2 years in some of the other disasters, I think in Italy, for example, in previous years? It's going to be key, and it's going to be speed that's important.
This is the liability question. Who ultimately has the liability, but how long before we have to find out the answer to that, AMH? And in between, is the president just going to offer the credit line to the federal government?
He said that yesterday. He said he has his full commitment to rebuilding this bridge and helping out this port. You also heard from a number of senators. Senator Ben Cardin as well said he does think Congress is going to step up. But Jonathan, to your point, a reporter, when the president was briefing, asked about this. It seems that a ship is at fault. Does that company have liability? And the president said that could be, but we're not going to wait around for that.
I want to turn to our next story, the latest out of Japan. Top currency officials in Japan expected to speak after the yen hit its weakest point against the dollar since 1990. A meeting earlier this morning between the BOJ, Ministry of Finance, and Financial Services Agency. Risa Rice in the Bank of Japan will intervene after the Japanese currency surpassed the 151.95 mark, which prompted the BOJ to step in during October of 2022. We had some comments from officials. Same official, the top currency official that spoke earlier this week. It's a repeat of what we've already heard, and we've said a million times. For verbal intervention to be credible, there has to be a policy effort behind it. It's unclear what that policy is going to look like and whether it's enough.
Especially because they keep saying, we'll take bold action if needed. If it's not needed when it falls to 36-year weakness, I mean, at a certain point, where's the line in the sand? We were talking about 150 being the line in the sand. Now it's 151. So this raises questions about their credibility as they've jawboned before, and it's not clear, to your point, what the policy response is and what the trigger is to really engage it.
Apparently it's something very close to 152. That prompts the words. I'm not sure what prompts the actions.
The words.
That gets the words. We're drawing lines in the sand here. Let's turn to China. President Xi Jinping urging US CEOs to invest in China, saying the economy has not peaked. Blackstone's Stephen Schwarzman, Qualcomm CEO Cristiano Amon, reportedly among the business leaders involved in today's meeting in Beijing. The talks lasting more than an hour and a half, according to Bloomberg's reporting. Bloomberg's Enda Curran joins us now in this story for more. Enda, was this for the CEOs or was this for Xi? Which one was it?
I think it's something of a sales pitch for China. As you mentioned there, John, our colleagues in Beijing got some details in terms of what was discussed. Like you said, it went for over an hour and a half. Some Q&A. The central message from President Xi being that they welcome U.S. investment. He doesn't see the need for the U.S. and China to decouple. He wants cooperation. He said the survival of both nations depends on each other cooperating, by the way. And of course, this all goes to this kind of idea that China is now on a fully fledged sales pitch, given the hit to FDI over the past couple of years. It's at a 3-decade low. We know on the portfolio side, money is also leaving. So when you have the top CEOs of US companies in town, it seemed like a perfect opportunity for President Xi to meet them and try and soothe some of their fears on both the economy and on policy direction in China.
And that's China's message. We're open for business. I wonder what corporate America's message is. Do you think it's our views are independent of our governments?
Well, it's often said there is some division between where the government wants to go and where the underlying corporates want to go. But look at what the data is telling us, John. Clearly, the tension is now moving into the real economic data. FDI is at a 3-decade low. It's not that US companies or other companies are pulling wholesale out of China, but it is that sentiment is very negative. And when it comes to expanding their business, they are looking elsewhere for opportunities. We're seeing that in the FDI data, and we're seeing it in the portfolio flows. US investors often make the point that China is uninvestable. It's not what it was. They're also putting their money where their mouth is. So there is some disconnect between commerce and the government. There always is when it comes to China. But as I would say, there's also some alignment now between the data and where the political direction is going to.
It feels like it might have been an awkward moment to have this meeting. Earlier in the week, we had the U.S. and UK talk about and accuse state-backed Chinese hackers of going after companies, politicians in the UK basically scrapping voter information. And is this something that still concerns American companies? And can she actually assuage those concerns?
And we had China lodging the case at the WTO on Tuesday against US electric vehicles. This is a common recurring theme, that even when you have this kind of headline effort to stabilize relations between both governments, or stabilize relations at least on a corporate level, beneath it, the tensions continue. And to your point, Anna-Marie, you're talking there about the hacking allegations again, another reminder of some of the charges against China. Of course, on the flip side, you have China making this case at the WTO. That's an example of where the geoeconomic race is at the pointy end of things. It is no doubt that, broadly speaking, relations have stabilized compared to where we were, say, a year ago, around at the time of the balloon incident. Both governments weren't talking to each other. But none of these other underlying concerns have gone away. It feels like we're on timeout until we get past the US election and see who comes out of that. We know one side will be very hawkish, but of course the other side will have to probably match that in terms of hawkishness if they're to get through it. So, as I say, it feels like a timeout, but none of the other problems have really gone away.
It's getting increasingly difficult to sort of parse the politics from the economic reality in the region. And I do wonder, especially yesterday hearing about Apple, their iPhone shipments in China falling 33% in February. Is this because of increased nationalism, or is this because the Chinese economy is doing far worse than people expect and is a less fruitful place for international businesses to look to pick up some extra profits?
I think there's a sense that the go-go years are pretty much behind China's economy at the moment, Lisa. I mean, the consumer story, it's probably not as bad as the overseas perception of it is, but nonetheless, it has been more subdued than has been broadly expected. You see that in, for example, that's playing into the Apple story. Xi Jinping apparently told his CEOs that they have the economy in hand, they have the issues in hand, and that the economy has not yet peaked. But at the same time, when you speak to business people, both here and those who operate in China, they make the point that China's government appears to be very reluctant to really turn things around there and to rev things up, and that is frustrating overseas investors and those who do business there. So I think there's something of a wet blanket over China's economy at the moment. They have a very aggressive growth target of 5% this year. Obviously, that's a political target, so chances are they will do what needs to be done to meet it. But in terms of animal spirits, I think it's a night and day in China's economy today compared to what it was, say, a year ago.
And Enda, you pointed to this reluctance by officials to really engage in any kind of significant stimulus. Do you have a sense of what some of the business leaders would like to see in terms of stimulus, and where sort of the wiggle room is for the Communist Party?
Well, I think people still can't push past the real estate story. Until that gets turned around, that's going to weigh on consumers, that's weighing on broader activity. It's such a multiplier in the economy. But then don't forget, people are also keeping an eye on what's happening on the manufacturing side of the economy. China is really putting in a lot of effort into the innovative and technology space there. There's a lot of concern that China is now exporting at a gangbuster rate into key sectors. Some trading rivals of China accusing them, of course, of dumping products at a cheaper rate on world markets. So even though the consumer side of things might be subdued, and of course the real estate story is very much subdued, China is pushing hard on the manufacturing and innovation space, and that is now drawing political tension around the world as well.
But are they trying to drum up that demand outside or inside China, Enda?
They're exporting surplus demand by all accounts. The suspicion and the allegation against China is that they're exporting, obviously we know the EV story, into the solar story, but they're exporting what surplus technology they have to find new markets for it. Now, of course, the countercharge from, say, business in Europe and the US is that they cannot compete with what China is doing. They're flooding the market with these key goods. It's a non-competitive race. And that's one of the underlying tensions in this story. So, as I say, the conversation on China's economy is that it's pretty much underperforming, but don't lose sight of what's happening in the manufacturing space. There's a lot of innovation going on there. They are investing hard in technology. It is a big priority for them, and they're clearly making grounds in key sectors.
And you're one of the best. It's great to catch up with you, sir. And Karen there of Bloomberg on the latest between the meetings between US CEOs and Xi Jinping of China. There's one man I'd like to speak to, Mr. Schwarzman, Blackstone, sort of Trump whisperer. Get his view on China and maybe what he'd say to the former president.
Do you think that Schwarzman wanted to hear what she had to say, or do you think she wanted to hear what Mr. Schwarzman had to say? I mean, Enda's talking about exports coming out of China, The Trump campaign is talking about a 60% blanket tariff on Chinese imports if he was to get in power.
I would say this. I don't know the answer to that, but I would say this. The balance of power between US CEOs and China has shifted, given what we're seeing on FDI.
Absolutely. We're looking at, what, 30-year lows on foreign direct investment. This was something that Xi Jinping had to come out and had to really make a moment. You know, he's supposed to go to the China in Davos, and he's not going there. But he made sure he met with these executives.
It's an ugly number. Let's turn to the price action. Equity futures on the S&P 500 shaping up as follows on the S&P at the moment, trying to bounce back from the mild losses of yesterday. Futures positive here, Lisa, by 0.4%.
All right, let's get you an update on stories elsewhere this morning. UBS has finalized a deal with Apollo Global Management for the carve-out of Credit Suisse's securitized product group. Apollo will purchase $8 billion in senior secured funding facilities. The deal allows UBS to close another chapter in its acquisition of Credit Suisse. It will book a net gain of about $300 million in the first quarter on the sale, and the private investment world will get bigger. Shares in GameStop are lower in the pre-market after the video game retailer reported plunging fourth quarter revenue. One of the original meme stocks, GameStop had seen gains following the Fed's messaging that a rate cut this year will likely be appropriate. GameStop's net sales were down 19% from a year earlier, and the shares are down about 19% in pre-market trading. A landmark agreement struck between Visa and MasterCard. Millions of U.S. merchants will see holders of luxury credit cards charged more at the checkout. The deal will allow retailers to pass on the premium charged to them for processing cards carrying the Visa Infinite or MasterCard World Elite branding. The plan is estimated to save merchants $30 billion in swipe fees over 5 years and set up a war between some of the card potential branders, because if you have one particular type of Visa, you're going to get charged a different fee than another one, and this has been the bread and butter of so many different banks.
If you've run a restaurant before, you know this story. This adds up. This is in our story today. I'll give you the numbers. A $100 transaction at a small restaurant. If a customer swipes a Visa Infinite card, that would cost the merchant $2.60 in fees. Traditional Visa rewards cards would cost just $2.10. That adds up over the year.
Massively. And you've even seen it in bodegas and things like that. Well, they'll say, if you use a card, we're going to charge you a 2%, 4% surcharge, because that's what they're being charged. This is massive. Who's going to bear the brunt of this? It's not Visa and MasterCard. It's all of the banks that are providing the base resources.
What about the airlines? Hey? I know there's a complaint in there somewhere.
Well, my complaint is, look, this isn't that profitable for you. Go back to the people who actually just travel and give them the upper hand.
Bramo, tell them.
And that's really the way to deal with
focus on customer service on the airline, without a doubt. Up next on this program, America's debt dilemma.
We're getting to a point where our public debt is going to start crowding out private capital, and we're going to have structurally higher interest rates.
That conversation up next.
I was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, you know, any given day it would be the head of a studio and, you know, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it, because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Equities right now on the S&P positive by 0.4%. In the bond market, yields just about unchanged, 423.76. There's so much going on in the land of commodities. Crude's just a small piece of it. We're down by 0.7%, $81 on WTI. We'll talk about this a little bit later, but AAA are talking about $4 pump prices this summer. That's a problem across a whole list of things.
It's a problem potentially for the goods disinflation story, and arguably, especially time-wise, it's a huge problem for the political season.
And cocoa as well, going through 10K yesterday, which I know you want to talk about.
It's crazy. I just am thinking the fact that it's actually more expensive than copper, iron ore. I mean, at this point, we're talking about a commodity. If you built a cocoa house, it would be incredibly expensive. It would be more expensive than building that entire house out of metal.
You're talking about a chocolate house?
Yeah.
Right, okay. I didn't know where you were going with that. I meant sort of like if you wanted to become a cocoa exporter. You mean like physically build a house out of...
a house out of cocoa. Like if you were going to go back to, you know, Hansel and Gretel and try to do that.
Sure. You ever made one of those at Christmas?
I was so bad at it.
Put the candy on?
Did you
Yeah,
ever
sure.
do a good job at that?
No.
They would like fall off.
You know, the ends would come off and stuff.
The gumdrops were always the worst. The gumdrops were really
Start to eat it too. All right, moving on. And the surveillance this morning. America's debt dilemma.
The cost of financing our deficits are going to erode more and more of our disposable income as a country, and I do believe we're getting to a point where our public debt is going to start crowding out private capital, and we're going to have structurally higher interest rates.
Here's the latest this morning. The BlackRock CEO, Larry Fink, in the last 24 hours, eyeing the risk of rising U.S. debt and its impact on the Fed's fight against inflation. Fink writing to shareholders, quote, "More leaders should pay attention to America's snowballing debt. Is a debt crisis inevitable? The answer, he says, is no." Here to discuss, JP Morgan's Bruce Kasman joins us now for more. Bruce, we're going to talk about monetary policy, the Fed, the BOJ. Can we just start on this with America's debt pile? I know you and the team at JP Morgan have talked about the boiling of the frog. Bruce, when does it start to get a little bit too hot?
Well, I think it will get too hot if we're right that the Fed just doesn't have very much room to ease. And over time, that begins to affect balance sheets. It keeps credit tight. It weighs on pricing power. It's a slow-moving story. And I think we have to recognize that so far, the effects of high interest rates just haven't done nearly as much damage as we would have thought to the private sector. So this story is playing out against another narrative, which is to say the private sector is healthy, we're getting supply side improvement. Hey, maybe we can live with high interest rates and actually generate a soft landing. We've kind of moved from being very much in the boil the frog stance to being agnostic about where this story is going to lead us.
Can you talk to me, Bruce, then about the supply side narrative that the chairman seemed to endorse in the news conference last week? What's the questions you have that sort of linger before fully embracing it?
Well, I think we should embrace it. There's an immigration story which is playing out right now and is boosting labor force growth. It's limiting the pressure on labor markets and inflation from rising jobs. I think we've also generated some pretty strong productivity growth, and that seemed to me to be linked with what we've been doing on spending on R&D and intellectual property. The question is, though, we still have a tight labor market. We have elevated inflation, which I think is sticky. I think, as you mentioned a minute ago, the goods price story globally is shifting here. I'm just not convinced that's going to be enough to get inflation all the way down to what will make the Fed comfortable over the next year or so.
Bruce, we've been talking a lot about the bridge collapse in Baltimore and understanding that it's just, one particular port and that potentially other ports can take in some of that traffic. But does this highlight to you that supply shocks have not gone away and that there are these vulnerabilities that will kind of put some sort of floor under this goods disinflation that we've seen for the past couple of years?
Yeah, I think what you're seeing in some senses is a little bit of that with the idea that there's some new pressures and shipping costs, and this port closure might be part of that. But also you're just losing the benefits of having unwound the dislocations. You know, you've had over the last 6-7 months, U.S. goods pricing, ex-food and energy falling at 2.5% pace. I think most of the indicators, both domestically and globally, are saying that's going back at a minimum to zero here. So when Chair Powell talks about shelter inflation coming down, I think there's an offset here of quite substantial, maybe even complete, of what's happening in the goods price story. And then that leaves the focus, of course, on inflation very much on how you think about labor markets and other service price inflation, which I think we're going to see is pretty firm when we get the PCE report on prices on Friday.
So taking a step back, this raises the question, and we were talking about it with Mohammed Al-Arian, about whether this is sort of a tipping point for this Federal Reserve in tacitly accepting a 2-point-something or a 2 to 3% inflation rate for the foreseeable future. Do you think that we have shifted, that this past press conference from the Federal Reserve was really the key moment in that transition?
I think what the Fed is telling us, it wants to start the easing process in the middle of the year, and it's willing to do so even if in the first half of this year it's getting uncomfortably high inflation performance. What I don't think this means is that the Fed is willing to accept on a sustained basis inflation close to or higher than 3%. And what we think is going to happen here is that you are going to see a pivot sometime around the middle of the year where the Fed maybe delivers 1 or 2 easing, but it really then starts to shift its guidance. The market today has over 150 basis points of Fed easing priced through the end of 25. Unless the economy gets into trouble, I don't think we're going to see that delivered.
You say they want to cut, which echoes a lot of individuals that come on the program, but they also continue to say how data dependent they are. What would they need to see in the data to actually say, you know what, we're waiting, we're not going to cut this year?
I think that's an interesting point because as they're talking data dependent, you could see Chair Powell in his press conference really talk as if the bar is pretty high to prevent an easing. So I'm not sure I have the numbers I'd want to be confident about where that is. But I think what they've told us, at least to start the easing process around mid-year, that they're fairly comfortable they've made enough progress. Yeah, there are data prints here that could take them off of that. And I would argue the committee, as you look at the projections, are probably more evenly divided on this issue. But I think the bar is pretty high here. I'm not even sure that if we get a couple of 0.3s on core inflation, which I'd say are high numbers, that's going to be enough to prevent a June easing. I think it'll stop them from doing much, but I'm not sure it'll stop them from easing in June.
Bruce, there's one inconsistency that jumps out to me, and perhaps we should finish here. How can the Fed simultaneously say we're restrictive and then at the same time embrace the supply side narrative of the labour market, but also point to the labour market as evidence of being restrictive? How does that add up?
Well, I think there's a level issue of how tight the labor market is, and then there's an issue of how much supply side performance is helping it. But I think you are raising an important point, which is that the supply side is improving and helping the Fed, but it is also a signal that the neutral rate is higher. And I think when you look at financial market performance here, it is embedding this idea that some combination of supply side performance, a friendly Fed, and some other things going on here is allowing us to do a lot better with higher interest rates than we might have expected. So I do think you're 100% right here. Policy is not as restrictive as the Fed seems to be suggesting. I think growth will do better if we're right that inflation is sticky. I think they are going to have to change their tune somewhat here, but it still looks to us like they're getting ready to at least start an easing process around mid-year.
It's hard to disagree at the moment. Bruce, thank you, sir. Bruce Katzman at JP Morgan. Going into that economic data on Friday morning. Coming up next on this programme, Katie Nixon of Northern Trust, Bloomberg's Katie Lines on the latest in Baltimore, Jeremy Papin of Nissan Americas, and Amanda Lynham of BlackRock. All of that and a whole lot more in the second hour of Bloomberg Surveillance. Up next.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffman arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Or other authorities.
Could face bigger challenges next.
It was going to keep bringing World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
It doesn't pay to be bearish, right? The data is way too good. You've got to stay bullish, and you've got to stay bullish on equities.
This is among the most record-setting periods of momentum that we've seen.
We don't have a Mag 7. We've got a couple stocks really driving it.
What we've just started to see, and I think this accelerate as we go through the year, is the rally broadens out.
We're still in a bull market. I think you stay invested.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance begins right now with your equity market on the S&P 500 positive by 0.4% on the S&P, continuing to track the fallout from the collapsed bridge in Baltimore. And Lisa, as we've said repeatedly already this morning over the last 60 minutes, just how much worse this could have been. The distance, the time between the Mayday call and the ability they had on the bridge to stop the flow of traffic, this could have been so much worse yesterday.
What a horrific event. And you're absolutely right. The idea that they were able to halt traffic did keep other cars from getting caught up in this. It does raise a question, though. How much time was there? What exactly was the cause? How long is this going to disrupt some of the traffic and some of the shipping? There's so many questions that remain. The focus right now is still on the here and after, the immediate aftermath of this. At this point, though, this is an artery that has been severed, as you put.
It could be weeks, perhaps even months before this port reopens, and then you've got to get into rebuilding the bridge. AMH, that could take a long, long time and a lot of money.
It could take a long time and a ton of money. We heard politician after politician and the President of the United States yesterday say that the federal government will support the rebuilding of this bridge. It was interesting, a reporter, Jonathan, in his quick news conference said, well, shouldn't the company responsible for that ship that caused this problem? And he said, potentially, but I want to get the funds there immediately. But you have to think, Congress has struggled to pass the most basic appropriation bills. This is a divided Congress, a dwindling Republican House. How are they going to get this funding through quickly? I don't know. They're on vacation.
1977, it took 5 years to build and $141 million US. This is going to cost a heck of a lot more money than that. Can we build it a lot more quickly, though?
When you take a step back, it also raises a question about the ability and willingness for the United States to invest in infrastructure and able to do it well and quickly. Yeah. This is, to me, I mean, it's sort of, this comes at a moment horrible tragedy. It also highlights a lot of the key issues that a lot of people in markets have been talking about for a long time. There needs to be infrastructure spending. We got it. Okay, how are we going to pay for it? How do we continue it? And what infrastructure is most important to prioritize when the nuts and bolts are aging, but you also have the big tech wars that continue?
So number one question in economics, I think, following this, there are many, but I think this is probably the number one. The disinflation we've seen in goods over the last 6 months feels a little bit fragile, perhaps even some challenges to that over the last 2 months. And you wonder just how fragile it is given what's developed just yesterday.
People are speculating this itself won't necessarily materially shift the needle when it comes to some of the overall national metrics. That said, and you put it well, over the past couple of months, we already got this drumbeat of have we seen the end of disinflation in goods? This just sort of highlights how supply shocks can exacerbate that floor under some of the disinflation that we had seen.
Let's talk about some other shocks. Let's get to the currency market. Let's bring up dollar yen and take a look at what happened with dollar yen overnight. Dollar yen overnight getting very, very close to 152. So close, in fact, that Bank of Japan officials, Japanese finance ministers get together with the Financial Services Agency and start making some noise, Bramo. They have a meeting. 150-197 is not where they want dollar yen to be. They come out, they start talking about it. But that's all they do. All they do is talk about it. When are we going to see the action to do something about it?
They go get together and make some noise. I mean, that's essentially
basically what they did.
I know. So this raises this issue, which is the market basically pushing and daring Japan to do something? Are they basically saying, let's see how much you actually care? What is the line in the sand? Is this a test in a way? Because we've seen this movie before, and yet still we're hovering at 36-year weakness levels for the yen.
This is what that verbal intervention bought them. Session high, 151.97 on the screen right now, 151.18, that currency pair in the yen's favor just a little bit by 0.2%. Coming up this hour, we'll catch up with Katie Nixon of Northern Trust on how the stock rally can broaden out from here. We'll speak to Jeremy Papin of Nissan on how the automaker plans to compete in the EV market, and Amanda Lynham of BlackRock on the competition for capital. We begin with our top story in markets. Tech dragging the S&P 500 to its third straight day of losses. Katie Nixon of Northern Trust saying a broadening out could extend the rally in stocks, writing this: financial services stocks have found their footing as the outlook for interest rates appears clearer. These developments are positive signs for investors. It is clear that the market can advance beyond those large cap names in tech. Katie, I'm pleased to say, is with us around the table. Katie, good morning.
Good morning.
Let's talk about interest rates. Lisa's asked this question a million times. Do banks need higher rates or lower rates? Are you saying they just need clarity on the rate path?
I think clarity is key here, Jonathan, and it's been really interesting. It's not just clarity, but it's lower volatility in interest rates. And if you look at the MOVE index, for example, that the volatility expressed in that particular fear and greed index of the bond market has fallen substantially. And I think that just gives clarity for banks on what the environment's going to look like going forward. Lower rates certainly help. A less inverted yield curve certainly helps. But lower volatility really helps the banks.
Why do you take this as a sign, a bigger sign, that maybe this momentum, this broadening out can continue? Why are you extrapolating out this moment beyond just the next few months?
Right. So it's not just the financial services stocks, Jonathan, but when I look across the board, the laggards have started to catch up slowly and unevenly, but they've started to catch up. So you can start in the U.S. with mid-cap stocks, mid-cap indices reaching highs. You can even look at value stocks within large cap and mid cap starting to beat growth stocks over the short term. So that's a good sign. You can look at some of the laggards in terms of the energy sector starting to pick up steam here. So the broadening beyond just those Mag 7, those big tech stocks, is really healthy. And then you broaden it out to looking around the world, and you can see European stocks finding their footing and starting to perform well. So I do think this broadening is a good sign of more confidence in the market rather than that sort of narrow breadth that we had in 2023.
This is such an interesting moment in markets, and I keep going back to this. I wonder how much we're seeing bonds as the risk asset, government bonds as the risk asset, and equities as actually, in some ways, the sure bet, because you got a Fed that basically is saying, we got your back, and you have an economy that continues. You've got fiscal stimulus. What's not to like? Have we gotten to this level where stocks are sort of the safety and bonds really are the risk?
I don't know if I would go that far, but I would say it's pretty hard to bet against U.S. stocks here, Lisa. And as you said, you've got sort of the macro working in your favor. You know, we've had better than a soft landing. We entered the year with a lot of positive momentum. Inflation is falling, again, albeit stutter-stepped, but falling. The micro picture looks better, broadening out of earnings. So we had a very narrow earnings growth in 2023 that is now broadening out. I think 8 of the sectors of the S&P are going to have positive earnings in 2024. And then you've got the policy. As you said, I wouldn't necessarily go as far maybe as to call it a Fed put at this point, but I would say it is clear that the Fed is on the path towards lowering rates in 2024. And that, again, is very supportive. And if you look at history, Fed rate cuts without a recession tend to be very good for risk assets.
Meanwhile, you have the likes of Larry Fink, but also even just government officials coming out and raising concerns about what's happening with the deficit. Do retail investors care about the deficit? Do they start asking, hey, is it a good idea to buy 10-year, 30-year bonds of the U.S. government if we think this is going to become a problem at some point in the future?
I can tell you, I think investors are starting to get concerned about the deficit, and I think that's why you are seeing potentially a setup where we just have a higher term premium down the road, right? There's a higher chance that we're going to have inflation run hotter. There's a higher chance that we're going to have these funding needs going forward in a huge supply, frankly, of treasuries that have to be absorbed. So I do think the average investor is starting to get concerned about it. We're certainly getting questions about it all the time.
Begs the question, let me ask you one then. If I'm looking at the yield curve at the moment, I can get 460 on a 2-year, there and thereabouts. Why should I go out further along the curve to a 10-year, say, to lock in 423? What's the incentive to do that at the moment, given what you just said?
I'll tell you, though, so here's the thing. So the upside here is that rates stay where they are because the economy is sort of trudging along. Inflation is coming down, maybe not as fast as we would like to see, and the Fed cuts rate. The downside, though, is that the Fed has to cut rates because we do see the economy in the second half of 2024 slowing down. Actually, we think the Fed's forecast is a little bit too bullish. So it could be a situation where rates do fall on the short end a little bit faster. And in that case, those juicy yields that you see today are just not going to be there for you when you really need them 4 or 5 years from now.
So Andrew Bors was in the FT yesterday, right? In PIMCO, over at PIMCO, in the FT. I'll get my words out, bear with me. And he's basically saying, if I want duration risk, I'll go elsewhere for it. There are limits to the cutting cycle. I can take this exposure elsewhere, maybe in Europe. What's the argument to take it in the United States?
Well, I mean, again, you're having clarity right now on the path of rates regarding the Fed. And then you can see, again, if you look at what's happened to the 10-year Treasury, for instance, this year, Jonathan, it's been really interesting because you had a little spike as we had inflation prints come in hot. You had the Fed come in and say, nothing to see here, don't worry, a bump in the road. And you had yields back off pretty quickly. And now we have the 10-year back, below our forecast range. So I think there is a lot of demand for fixed income and for treasuries right now, given the environment and the outlook. So I think you're going to see that demand come in as we see rates go up, and it's ultimately going to put a ceiling on how high rates can go.
Just to kind of put a bow on it and sort of underpinning what Andrew Bors was getting at in his FT piece, PIMCO being cited there, how much are you looking at a higher inflation regime at the United States that is different from the regime in other countries?
Well, I think great question, and I think we heard a clue in the press conference, not in the statement, but in the press conference last week, that there is a bit of a tolerance for a longer period of higher inflation, perhaps not for a ultimate higher inflation goal, but to tolerate a longer period of higher inflation in order to maintain economic growth. Sort of recognizing now that there may be a trade-off between getting inflation down to the target and maintaining economic growth and maintaining full employment. So I think there's much more of a balancing act going on now in the Fed than there was earlier. It was just fight inflation. Now it's sort of like, well, we want to get inflation down patiently, but we really want to maintain unemployment at or around 4%.
When I look at some of the equity strategies that come around higher inflation, they all point to oil. You were mentioning energy. How much is that sort of the sweet spot right now as a hedge?
Well, Lisa, you mentioned it earlier. The supply shocks that we're seeing, many of them are around energy. We see issues in the Red Sea. We see issues in the Panama Canal. There are issues with transport and logistics now around energy. I think we're seeing now not just a soft landing here in the U.S., but we're seeing recoveries overseas. So you're going to see global demand for energy come up. So I do think it's a great place for investors to be. And, again, Jonathan, to your point about, broadening out of the market, that's an area of the market that was left for dead last year. So again, investors should look at their portfolios and see, am I positioned for the next year, the next 5 years? Do I have my small mid cap? Do I have my non-US exposure? Do I have my energy exposure and my inflation hedges in my portfolio? Because it is possible that we are living in a higher for longer inflation period.
Well, JP Morgan's talking about $100 a barrel of oil potentially this year. When you talk about exposure to energy across the board, or do you want to move into more of the old school energies that are picking up pace? Or are you still like maybe potentially clean energies as well?
I think it's both and at this point, and I would even expand it beyond energy to the broader commodity complex. It's been interesting to see all the attention on artificial intelligence, for example, and it's certainly driven the Mag 7. But if you sort of scratch beneath the surface, you see there are all sorts of tentacles into the commodities market, into the energy market and other commodities that are required to support the growth in AI that's getting all the attention right now. So I think for a variety of reasons, you really want broad exposure in the energy market and in the commodities market today.
Kelly, this was great. It's good to see you.
Nice to see you too.
Thank you. Kelly Nixon there of Northern Trust Wealth Management. Brent crude at the moment down by 0.7%. 85.65 on Brent. Equity futures bouncing back on the S&P 500. Slightly firmer this morning. Lisa higher by 0.4%.
All right, right now let's get you an update and stories elsewhere this morning. We've been talking about this all morning. Japan stepping closer to currency intervention. Maybe. The country's finance minister ramping up hints of possible action after the yen touched its lowest level versus the dollar in 34 years. Policymakers are running out of choices short of purchasing the currency to prop it up after the Bank of Japan's first interest rate hike since 2007 failed to change the yen's trajectory. Chinese President Xi Jinping has told a group of American business leaders in Beijing he wants U.S. companies to invest in China, putting aside differences on what he said were, quote, minor issues. Xi met with leaders including Blackstone's Steven Schwartzman, Qualcomm's Cristiano Amon for more than 90 minutes. China is seeking to restore confidence in its economy, with Xi acknowledging issues with the domestic economy, but saying it hasn't yet peaked. Drug maker Altimmune could have cracked a problem which has been weighing on obesity drug makers. Patients on the latest trial of its experimental drug saw 74% of their weight loss coming from fat tissue. The company says that mirrors the results from diet and exercise programs. By comparison, trials of the active ingredient in Ozempic and Wegovy show a higher rate of lean muscle mass loss compared to fat. That's your Bloomberg brief. John,
that's a big deal.
That is a big deal.
They should call that shred. They really should. That is the ultimate dream. That's the dream thing.
100%.
That's right there. That is the dream shot.
I mean, this was one of the complaints that I heard anecdotally that people were trying to work out, and the trainers were saying to them, really? You guys can't do anything because of the Ozempic shots that were just stripping them of all their muscle. If they can shred, Operation Shred.
There you go.
I mean.
Did you watch the Oprah special?
I actually went back and watched a little bit of it.
The
It was
correlation between lean muscle mass and longevity is a real deal. So this is a big issue. Reminds me of another story, actually. You see this one at the ECB?
Which one?
Olive oil. This story is the funniest story ever from Politico. There was a staff mutiny over the quality of olive oil served at the European Central Bank.
I love that.
You seen this?
Oh my God, no,
In
I
the
have to go look
canteen,
it up.
narrowly avoided after in-house caterers acquiesced to demands to bring back extra virgin options to the table. It looks like on the internal message board, the Italians were going after the Germans.
You're so proud
in
of
Frankfurt. I'm so proud.
I know.
This
This is the way to go.
I was in the car on the way to work this morning reading this story from Politico, and I just smiled from ear to ear. It was just like,
thank you.
God bless the Italians.
For trying to bring some health and sanity to the diets.
You know, just to try and
people
bring
worldwide.
real food to the people of Germany.
Preach.
Up next on this program, a big rebuild in Baltimore.
The path to normalcy will not be easy. It will not be quick. It will not be inexpensive. But we will rebuild together.
That conversation up next. On the ground, Kelly Lyons, just around the corner.
multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Drew Mattis met life just writing in. Great story. Says one time he was delayed, 10-hour delay in Rome. And all the Americans immediately went to the counter and were asking for any flight to the East Coast. And all the Italian passengers were asking who was going to feed them.
That's amazing.
Said my wife and I still laugh about it. Isn't that a great story?
Well, who and what are they going to be fed with?
It's just fantastic. Love that. If you're just joining us, welcome to the program. Equity futures on the S&P 500 shaping up as follows. The S&P positive by 0.4%. Yields just about unchanged on a 10-year, 422.58. Under surveillance this morning, a big rebuild in Baltimore.
Our work is just beginning to rebuild this bridge and deal with impacts in the meantime, to reopen this port and deal with supply chain impacts. The path to normalcy will not be easy. It will not be quick. It will not be inexpensive, but we will rebuild together.
Here's the latest we have this morning. Officials suspending search and rescue efforts with 6 individuals unaccounted for after the collapse of the Francis Scott Key Bridge in Baltimore. President Biden pledging federal support to rebuild the bridge with weeks or possibly even months of disruptions expected. On the ground is Bloomberg's Kelly Lyons. And Kelly, we've been talking about this through this morning, how bad it was, but how much worse it could have been.
Absolutely, John. Of course, there was this construction crew present on the bridge at the time that the dolly rammed into a structural support beam and it subsequently collapsed. It is those 6 individuals that they are now not searching for rescue purposes, but for recovery purposes. But the fact remains that there was enough time from the Mayday call of the ship in which they, of course, were experiencing distress, ultimately lost power and control of the vessel, hence the collision with the bridge. They were able to alert port authorities soon enough that they stopped further traffic from coming onto the bridge. So it is likely that that action was able to save some lives here, even though unfortunately it does seem, according to officials, that 6 other lives are presumed to have been lost at this point. That recovery effort is ongoing as we speak, and then it will move forward into the investigative phase. The NTSB likely to board the vessel today to begin their investigation with a 24-person team. And then, of course, it's going to be a matter of trying to actually get the ship out of the harbor and clear the debris, not just from the ship and its containers, but from the collapsed bridge as well. This is going to be a multi-pronged effort, and I actually spoke yesterday with a Democratic senator of Maryland, Ben Cardin, about those future steps. This is what he told me.
Search and rescue is the priority, but they're already planning on what's going to be necessary to get the channel open and to get this bridge replaced. Every day it's closed. Every day the harbor's closed. It's millions and millions of dollars lost to the local economy. People are going to be out of work. They're not going to get paychecks. We got to move with great dispatch.
So clearly there is an economic impact here locally for Baltimore. There are more than 100,000 individuals whose jobs depend on the operation of the port of Baltimore, but there's also the consideration of the ripple effects it could have for the national economy. And the fact remains there is just no timetable at this point firmly that authorities have been able to point to estimate, to indicate when the port may be back open or when this reconstruction may happen and how long it may take.
Great interview with Senator Cardin. He also told you he's hopeful that Congress will actually act and step up when it comes to the funding to rebuild this bridge and the funding to support the port. Keely, how quickly could we see Congress act?
Well, that's an excellent question, Anne Marie. Of course, we heard from President Biden in remarks yesterday. He said he does intend for the federal government to pay entirely for the reconstruction of this bridge. In theory, some of the funding breakdown will happen more immediately from emergency funding. There's a question of what infrastructure funds that have already passed Congress could be drawn upon for this effort, but likely it will require a supplemental request from the White House to Congress. And yes, Senator Cardin, as well as his other Democratic senator from Maryland, his colleague Chris Van Hollen, both expressed confidence that Congress will do what it takes to get this passed and that the Maryland delegation will be pushing for it. We have seen that funding is very difficult to get across the finish line in terms of the actual appropriations, the fiscal year that it took almost 6 months to actually finish and get through both the House and the Senate. And of course, a supplemental funding request related to emergency aid for U.S. allies still has gone nowhere in the House. So we'll see if this can happen in a more expeditious manner. It is worth keeping in mind that Congress is in recess this week. As we speak, they won't be returning until later on in April.
The International Longshoremen's Association 6-year contract, Kaylee, is also coming due this year. How does this impact those negotiations?
It's a good question. Obviously, we have seen some disruptions of port workers broadly, not just here on the East Coast, but the West Coast as well. It took some time to get that dock workers contract sorted. And as I said earlier, there are thousands of individuals who are employed by this port who are probably worried at this time about job security. This is something that I actually had indications of in my conversation with Senator Chris Van Hollen. He talked about how, yes, we are seeing companies already diverting cargo, some of these shipments moving to ports either to the north, like New York or New Jersey, or to the south to Norfolk down in Virginia. But he wants to make sure that things come back to Baltimore when this port is reopened, that this is not a permanent disruption to trade flows, but just really a temporary diversion until the port can be reopened, that there will be job security for all of those here in Baltimore and the wider economy that depends on the operations of this port. And that is likely something that they will be looking for in the months to come.
Katie, can we just finish up with a description of what you actually see with your own eyes? Because, Katie, I think it's amazing to be sitting here talking about the rebuild. We need to talk about the cleanup. There is a 1,000-foot ship stuck there and the bridge debris all over the place. How long is that going to take?
It could take some time, John. Really, frankly, the scene we see before us is almost apocalyptic. As you're coming in off the highway, of course, that you can transit to come here to the actual port area, you see a bridge that once was very prominent in the Baltimore skyline that is just no longer existent. Parts of it still sticking up, many parts of it submerged. Right behind me is a highway that literally goes to nowhere. It just cuts off because there is no continuation over the water of a structure that can support vehicles to go across. This is really extensive damage that has been done, of course, because this is, as you say, a very large vessel that ran directly into a beam of support for this bridge. It only took seconds for all of it to come crashing down, and it's likely going to be a long effort, not just to get the debris off of the ship, to figure out what is happening with the actual shipping containers that were on it, whether any hazardous contents were inside. Once you get the ship out, then you got to start getting everything out from under the water.
Hey, Kaylee, wonderful to hear from you. Katie Lyons there in Baltimore. Lisa, just going through why this cleanup could take a long, long time.
Which is the reason why there's some estimates that ship isn't going anywhere for weeks, if not even potentially months.
Yeah, never mind the rebuild. Got to get through the cleanup effort first. Coming up on this program, Jeremy Papin, the chairperson of Nissan Americas, on how they plan to compete in the EV market. That conversation up next.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
Stock market bouncing back by 0.4% on the S&P 500. Pretty stable gains through this morning so far. On the Nasdaq up by almost 0.5%. Outperformance on the Russell, the small caps up by 0.7. In the bond market, 2-year, 10-year, 30-year. Look a little something like this, 458.48. Yields a little bit lower by not even a basis point on a 2-year. Similar price action on a 10-year at 422.18. I'm actually pretty interested in what Mr. Balls over at PIMCO had to say in the FT yesterday. If you want duration risk, why take it in the United States? Given the limits that people perceive there are to the rate cutting cycle, and ultimately the growth story in the US is much better. If you want to take duration risk on a growth slowdown and a big rate cutting cycle, should you take it elsewhere?
That, to me, honestly, also raises questions about, is the U.S. in a uniquely inflationary moment that's different than, say, what you're seeing in Europe, just simply because it is a beacon of strength. And yes, maybe there are productivity gains, but there also are limits to that. And we're seeing that in the goods sector with maybe the end of some of the disinflation there.
Speaking of unique moments, switch at the board and get to foreign exchange. Dollar yen. Overnight, session high, 151.97, triggering some verbal intervention, strongest yet, without any currency intervention off the back of it. 151.06 is where we are now, down 1/3%. That is Japanese yen strength. The BOJ, the Finance Ministry, the Financial Services Authority over there getting uncomfortable with the one-way traffic we've seen in the currency market.
How uncomfortable are they? And basically that's the question that the market is asking, because it doesn't seem like there's particular concern that there's going to be some dramatic intervention that's going to reverse the slide in the yen. At this point, you have to get the Finance Ministry and the Bank of Japan on the same page, or else, frankly, this market is voting with the Bank of Japan, and the Bank of Japan is in no hurry to really raise rates materially.
Yeah, that dovish hike, a regret, do you think? Maybe?
It doesn't sound like it, because we heard from a Bank of Japan official overnight, and this is what triggered the additional weakness, basically saying we need to be cautious, we need to be very, deliberate and slow, basically doubling down on the moves that they just took.
151 on dollar yen. Under surveillance this morning, 6 people presumed dead after the collapse of the Francis Scott Key Bridge in Baltimore. President Biden saying he wants the federal government to pay for the rebuild, vowing to, quote, move heaven and earth to reopen the port and rebuild the bridge. The collapse posing a further strain to global supply chains, with the port one of the busiest on America's East Coast. Anne-Marie, the rebuild, you've got to do the cleanup first, which is what we talked about with Kaylee just moments ago.
Absolutely. What you're hearing from officials is that this is going to take weeks, if not months, just for the cleanup before we even start talking about the funding and what's going to be needed in terms of the infrastructure to rebuild this. I will go back to what Brendan Murray said earlier, though. Is this an isolated choke point, or can we potentially see a domino effect? It looks like at the moment, companies are already able to reroute. GM, Ford, they're saying we're going to move to Georgia. You brought up a great point about coal to India. That's a lot of coal that actually goes to India from this port. Are they going to have to rely more on Russia and potentially Australia to bring in some of those coal? And then at a time, we are seeing commodity prices on the upswing.
What I want to understand also from executives and some of the industries that use this is just how much are they building in things that previously were thought as inefficiencies to compensate for disruptions in supply chains? How much do you have to do overlap just to keep that security in place post-pandemic? And that is something a lot of people have been really looking at.
Well, this could be a big disruption. Here's our next story, this from China. is filing a complaint to the World Trade Organization over America's EV subsidies, saying parts of President Biden's Inflation Reduction Act are, quote, discriminatory and have seriously distorted the global supply chain for electric vehicles. The US hitting back, top trade official Catherine Tai saying China continues to use, quote, unfair policies and practices to undermine fair competition and dominate global markets. Now, often, economics can come up with its own jokes, Bremo, but the complaint that we're getting from China is very similar to what we heard from some European officials on the same issue.
Okay, there is maybe some legitimacy in terms of what measures are being taken. At the same time, it is a bit rich for it to be coming from China. And basically the tit for tat, we have Janet Yellen, Treasury Secretary, speaking in Georgia this morning, talking about China's overcapacity, distorting global prices, and talking about how this is a real competitive disadvantage. This is going to be the tit for tat. But now how much is this protectionism and nationalism and all that, and this is sort of the new reality for the global economy?
I had the same thought you did, Jonathan. When I saw this, I said, well, there's some Europeans who actually would agree with Xi Jinping when it comes to this. But I think the nail in the coffin for China was in the recent months, the United States finalizing those reductions. And if you're from a country of foreign entities of concern, AKA China, you can't tap into those subsidies, which means no one's going to buy your cars in the United States.
Stones, glass houses, all round on this front, right? I think we can all agree on that. Sticking with EVs, shares of BYD falling in Hong Kong trading after the Chinese EV maker's earnings missed estimates, raising questions over whether it can sustain its strong profit growth amid an intense price war. One company looking to double down on EVs is Nissan, the Japanese automaker targeting an additional 1 million vehicles by 2027, including reducing the cost of EVs by 30%. The CEO saying, quote, we have to change our ways to compete with companies like BYD. Joining us now is the chairperson of Nissan Americas, Jeremy Papin. Jeremy, great to catch up with you, sir. Let's just talk about the new release for you, and you help me understand what's going on in this market at the moment. Nissan Kicks. I know you're excited about it. I want to understand if there are too many EVs in this market, or whether you just think there's not enough at the right price point.
Yeah, look, we're very excited about the Nissan Kicks. It's I think, the car the customer wants at the moment in the US. It's a combustion engine, absolutely great design, affordable price point. We're bringing a lot of technology, a lot of fun to drive to the marketplace. And so we think we're just hitting the market with a new vehicle in the sweet spot of what the consumer is wanting at the moment. That's for the new Kicks. In terms of the EVs, the growth is there in the market. Perhaps the consumer moving into the EVs is at a slower pace than what some had dreamed about, but the growth is there, the interest is there, consideration is growing, and once people have driven EVs, they are very loyal to that type of powertrain, and so we think we will be seeing a steady growth in the market.
Jeremy, there are some reports that you have to offer dealers at the moment anywhere between $500 to $2,000 cash per vehicle to take on more inventory. I'm just trying to get some transparency from you just to how difficult things are in this moment. Jeremy, is that story true? Can you verify that?
I think the story is a market story. I think there are a number of brands that have to deal with some inventory situations, and helping the dealers with floor plan and availability is part of our job. We're doing it in cooperation with the dealers. And so it's just, short-term epiphenomenon. I think the key is having exciting brand advertisement and bringing the new cars to the market for the consumer to show up on the showrooms and take those cars home. So there's nothing specific to what Nissan is doing in the market at the moment. We are adjusting to good demand and the fact that consumer is looking at this monthly payment, and we're helping them in every way we can.
Are dealers pushing back, Jeremy, more on having more electric vehicles on their lot simply because there hasn't been the demand that many people were expecting?
I think the dealers, they do see the growing interest. They do also face the need to perhaps spend more time through the process of explaining all the technology that goes into the EVs. I think there's one point of notice that Nissan is offering is that we know there's a lot of technology that goes in the EVs. We are offering a second delivery, which is an opportunity for the customers 8 days, 15 days after buying an EV at Nissan to actually have someone come home and re-explain and reintroduce and make sure all the technology is being used the right way, whether it's EV charging, ProPilot assist, driving assistance, or any of the connected services features that we have to offer. And I think that's what we all need to do, is educating and supporting the customer into getting the full access to what we have to offer through EVs, because they are packed technology cars.
But how do you keep up when BYD continues to cut prices?
That's a story of the industry. There's been always the need to be cost efficient. And so I would say we're very used to it. Ourselves, we're working on breakthroughs for our EV production, fewer parts, more simple to produce, greater economies of scale. I would say it's just what the auto industry is about. There's nothing specific. One day, one company is more aggressive on prices. The next day, it will be maybe another one. And we keep up with the pace of transforming those productivity gains into more affordable products for the customer. So it's healthy competition.
Do you think the market missed an opportunity to push hybrids, given the fact that we've seen more uptick in hybrids and people have been a little bit resistant to go full EV?
Again, I think what matters is the fact that we can all offer what the consumer wants. In our plan that you've mentioned, the new ARC plan, the midterm plan, we will be launching 30 new cars and trying to grow the business by 1 million units. 15 of those new 30 cars will be electrified. And in the US, we will get 7 new cars over the next 3 years in all powertrains: combustion engines, battery EVs, hybrids, PHEVs, because what matters is just to be able to offer the consumer what he wants. And so that's coming. That choice, I would say, is coming in greater numbers, including at Nissan.
Jeremy, I feel like we should call all executives of car companies ambassadors at this point, because it seems like you're trying to navigate the geopolitics of the world in a very fraught moment. And I wonder how much you're having to change your business structure to prepare for increasing tensions in different regions where you're not allowed to sell vehicles with parts from other countries that are specific.
I think the industry praises stability of rules and can cope with any rule that is being set. And so that's the most important for us. We make decisions early on. We make decisions today on the products that will hit the market in 2028, 2029. Billions of dollars are being invested. And so what matters is the stability of those rules, essentially whatever they are. And so that's what we're very focused on. We know how to adjust to any set of regulation that is being thrown or set up for us, and that's how that's where we make our business.
Jeremy, what I struggle with now is how you gain economies of scale, trying to do 3 different things simultaneously. So to satisfy the Chinese market with EVs and to simultaneously satisfy the US market with hybrids, you've got to do different things in different places. How do you generate cost reductions, achieve economies of scale when you have to do all of those different things simultaneously?
Yeah, I think regional size is what matters. China for China at Nissan is something that's working very well. And we will be launching in China over the next few years 4 new energy vehicles completely developed, localized and produced obviously by our Chinese for China business. And then elsewhere in the US, in Europe, or in our Japan business, we're trying to leverage global scale where it works or regional scale where it can. We've got a very big presence in North America, both in US, Canada, and in Mexico. And there's enough volume to generate, again, the economies of scale to be competitive. And being competitive just means bringing the cars at the right price for the customers to be very happy with those.
The question that Lisa asked, though, I think is a really important one, and it plays into this discussion that we are having. Can you generate global scale when it feels like these markets are becoming increasingly regional? And you mentioned the regional effort. I want to understand, and I'll ask you direct, what happens if we get the former president coming into power and he doesn't just put big tariffs on what's happening in BYD and with Chinese automakers in Mexico? He does it across the board, puts the walls up and shuts everything down. If we shut down the global auto market, it becomes heavily regionalized. Does it change what you do, or do you think the market was already moving in this direction?
I think the market is moving. I mean, with COVID and the semiconductor crisis, we've been obviously much more knowledgeable and careful as to how the logistics routes are set up across the industry. We've been thinking about dual sourcing and more insuring of the activities. And so that's a trend that, you know, we want to continue. Building where you sell is a recipe for success in this industry. And so we are obviously very committed to making investments in North America that will help manufacture all the vehicles that will be sold here. And that's really, and so again, any change in regulation, I would say, we can cope with and adjust gradually. They just need to be stable over time.
Jeremy, thank you, sir. Nothing stable about the last few years. Jeremy Papin of Nissan Americas, thank you very much and good luck with the new product launch. We'll speak to VW a little bit later, and I think the conversation we have to have with VW is how do you plan for your manufacturing footprint in the United States of America before getting clarity on the future? Clearly, they'd like stability. Stability is not what we have in Washington, D.C. at the moment.
Also, the point about if Trump were to come into power, those subsidies that are driving some of the EVs, even though this market is seeing a glut and we're not seeing that demand, the subsidies are there to try to help. If Trump comes in, maybe they won't attack the full IRA, but he can rewrite the Treasury rules and make it much harder at the Treasury Department, make it much harder to claim those subsidies. So until you know who's going to be president, it's also very hard to see the demand and what's it going to be for the EV market in the United States.
Some pretty lofty goals over at Nissan. We'll catch up with VW in about 60 minutes from now. If you are just joining us, equity futures on the S&P 500 trying to bounce back near session highs. Lisa, still positive about 0.4%.
Right, it's basically stability there. Elsewhere, maybe not so much. Let's get you an update on stories elsewhere this morning. The search and rescue operation after the collapse of the Francis Scott Key Bridge in Baltimore is now a search and recovery mission. A road crew was working on the bridge at the time of the collapse. 2 people were rescued, 6 remain unaccounted for. The area remains closed off to traffic, cutting off a major artery around the city. UBS has finalized a deal with Apollo Global Management for the carve-out of Credit Suisse's Securities Products Group. Apollo is said to purchase $8 billion in senior secured funding facilities. The deal allowing UBS to close another chapter in its acquisition of Credit Suisse. It'll book a net gain of about $300 million in the first quarter on the sale. And Brent could hit $100 this year if Russia's decision to cut production isn't balanced out by other countermeasures. This according to analysts over at JP Morgan. The bank saying the actions could see the price of oil hitting $90 next month, close at triple digits by September. Russia saying its decision to deepen its production cuts was based on expectations for global oil demand growth. So this really raises this question, is this the boy who cries wolf again? Because we've heard this before. Or is this truly going to be the time where the market wakes up to the fact that demand isn't falling off a cliff?
Yep.
And we are seeing supply that is being constrained.
We reflected on the Morgan Stanley forecast, which was something like $90 Brent 3Q. And 90 sounds like a big number. Then you look at Brent, which is basically 86. We're $4 away. We've had this sort of stouty rally back higher in crude.
Which raises a lot of questions about the timing, because not only are we talking about the disinflation narrative and whether this challenges it, but we're also talking about, you know, the silly season for politics, as Tiki would say.
That's the latest in the commodity market. Up next on this program, the competition for capital.
You really have started to see the competition between public markets and private markets drive credit spreads tighter. Over time, you're going to see a convergence of those two markets, and it does create a bit of froth with pushing spreads tighter.
That conversation up next. We'll be catching up with BlackRock's Amanda Lynham.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal?
The Deal?
The Deal. The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
This is Bloomberg.
Following 3 days of losses on the S&P 500, equities bouncing back on the S&P, up by about 0.4% through most of this morning so far. Yields just about unchanged to down a basis point on a 10-year, 422.18. Under surveillance this morning, the competition for capital.
I think the story has changed where there's such a competition for capital that you really have started to see the competition between public markets and private markets drive credit spreads tighter, start to make covenants a little bit less strong. Now you're seeing it look much more similar to public markets where there's lending groups, including private and public lenders. And I think over time, you're going to see a convergence of those two markets, and it does create a bit of froth with pushing spreads tighter.
Here's the latest. Credit spreads at their tightest levels going back to 2021, with investors weighing how Fed rate cuts could see them tighten further. Amanda Lynham of BlackRock expecting cuts to start in the second half and writing this. While a high-for-longer cost of capital environment poses fundamental pressure for some floating rate borrowers with limited financial flexibility, competition between syndicated and private markets coupled with ample private debt dry powder has encouraged tighter pricing, especially for large borrowers who have access to both markets. Amanda, I'm pleased to say, joins us now for more. Amanda, good morning to you.
Good morning. Thank you.
The EMP Paribas were with us yesterday, and they were talking about a soft landing in credit. Is that your kind of world, your view on things at the moment?
And good morning. Thank you for having me. I did see that interview with Megan yesterday. I think I would agree with that. I think the bar for significant disruption is really high in the corporate credit market. We do, though, expect dispersion, and we are actually seeing that to a pretty significant extent more recently in the U.S., European, and Asian credit markets. Two things I would note. On the point of kind of competition between public and privates, I think the way we're viewing it as maybe several years ago, if you were a corporate in LevFin, you would have made the decision between issuing a bond and issuing a leveraged loan. Now there's a third option. And so you've actually seen private credit become a viable option for the opportunity set for a lot of corporates. Not every corporate needs the size to become index eligible in that market, but it is a viable third option. The other point is, I think, on just the terms of having more access outside of the banking channel and the public markets, we believe has been a good thing for corporates, and you actually see that in what I would argue is a pretty muted default rate, given the interest hikes that we've had since March of 2022, and I think that shows that it's working.
And Bob Michael of JP Morgan was talking about that, the ballast kind of to some of the credit sphere. I do, though, want to just sit on this idea of froth. Yes. And that's something that Megan was talking about, that there is this froth developing in tighter credit spreads because of the increased competition. Sounds a lot like the equity market. Exuberance, but it makes sense. So it can go on for a long period of time. Is that kind of what you see?
We see it, and I would say it's not exclusively limited to the LevFin market where there's overlap with private credit. You also see super tight credit spreads in investment grade. To me, actually, it reflects a few things. One is fundamentals are pretty good. Economic backdrop is pretty strong. But if you look at spreads, they look really tight optically. If you look at all-in yields, however, going back to the post-financial crisis period, we're talking really cheap levels on a percentile basis. If you were to look at just daily spreads, daily yields back to 2010, yields screen really cheap and spreads screen really rich. So I think that's part of it, is that the marginal buyer in credit is actually yield-based. So when they're coming to deploy capital, they're not looking at it on a spread versus an index. They're looking at where can I lock in all-in yields. And I think it's fueling some of that optically tight spread measures in credit, as opposed to, it's not indiscriminate, because again, we are actually seeing CCC's lag. We're seeing actually a pretty significant share of credits that are trading above 1,000 basis points in spread. You're seeing dispersion in the single name capital structure, over leveraged capital structures that are doing liability management. So I would say if it were kind of a rising tide lifts all boats and everything was rallying, I would say we are entering into kind of maybe possible over exuberance, but we're not seeing that. We are actually seeing some discrimination under the surface.
That's what I really wanted to get into. If I just go over a part of that quote again and just read it out loud for the audience. Competition between syndicated and private markets coupled with ample private debt dry powder has encouraged tighter pricing, especially for larger borrowers. Yes. Is it just the larger borrowers? Who's getting left for dead here?
I think it's largely in the high end of the size spectrum where companies have the ability to run dual track processes, so they can actually see, okay, again, going back to that point of I've now got this other third viable option, where am I getting best execution? I think the pricing is most competitive at that end. But again, it's not, I do think there's not a sense that folks are being left behind in the sense that competition is pricing them out. I think what it is doing is it's just changing that mix shift. In late 2023, we saw a lot of public debt being refinanced with private debt. That shifted in the first quarter now that the syndicated markets are open, and we're seeing a lot of private debt actually getting refinanced in the public markets. But those companies need to be ready to be public market.
Just following up on Megan's point, how concerned are you about weakening covenants, weakening deal terms? Is this something that you see sowing the seeds for something that might not come home to roost this year, maybe not in 25, but maybe 26?
Yeah. Well, most of the syndicated market is cov-light, as you know, on the leveraged loan side. And as the high-yield bond market has become more institutionalized, covenants have become less of a binding constraint in that market, too. It's really the private market that has a lot of the covenant protections. I think the big risk that I'm concerned about for risk asset valuations is a sustained reacceleration in inflation that the Fed cannot deliver at some point in 2024 on rate cuts. Not that rate cut in the form of rate relief is so game-changing for those credits, but I do think that it's really important for sentiment, and I think that's where you might start to see things really unravel from a risk asset side, is that we don't get any rate cuts in 2024. We're in this extended high for longer into 2025, and I think the key there is if that's happening because inflation is sticky, that is problematic. If rate cuts are very shallow in 2024 because of high growth, I would view that as less of a problem. But if that gets postponed, I think that's an issue.
Just quickly, maturity wall.
Yes.
Red herring or not? Big issue or something to ignore?
I was very concerned about it in the fall of 2023. I think the fact that the capital markets have remained open to lower rated issuers to allow them to get that refinancing done, it's relieved a lot of pressure. In European high yield, it's a steeper maturity wall than the US, so I'm watching there.
Interesting. Thanks for that. Amanda, great to catch up. Thank you. Amanda Lanham there of BlackRock. Had to get something bearish in for Bramo at the very end of the conversation.
But basically,
anytime.
she didn't really bite. She said, ignore it.
Watching Europe, though.
Yeah.
Interesting.
Thank you. Thank you for throwing that to me.
That's what I'm here
Europe
for.
is the bearish place.
Coming up, Keith Lerner of Truist. What's new about that?
Fair.
Yeah, I know. Rich Clara of PIMCO and Pablo De C of Volkswagen. All of that and a whole lot more from New York City. This is Bloomberg.
The linear business is not going anywhere. The sports business is moving and is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have two assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything. The top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Central bank policy, particularly with regard to the Fed, is very, very binary. They either cut or not.
They don't need to wait for inflation to come all the way back down to 2% to actually start cutting rates. We just need to be confident that things are evolving in the right direction.
They're kind of trying to tell us that we're on a path to get to rate cuts now. Inflation has come down enough that they think that they can be cutting interest rates.
We can still get 3 rate cuts despite some of the hotter inflation data.
They're trying to play the waiting game. Eventually, they're going to have to suppress the front end.
This